and you were getting nervous about your future in the next round of financing. So put your hands up if that sounds familiar to you. It's really, really awesome to have a couple of honest people in the audience. Everybody who hasn't raised their hand either is a liar, sorry, or you haven't been around long enough. I think things like this happen to almost everybody at some point. But let's try to understand a bit better why this happens and maybe what you can do to deal with it, or even better, to prevent it in the first place. Why is it that companies sometimes go from boom to bust in a matter of months? There can be many reasons for this, but I think the two most important or two most frequent reasons are a couple of things. If you suddenly find yourself in a situation that's much worse, and it's probably because two things happened. Growth slows down, and at the same time you keep spending cash according to your original plan and expectations. And what then typically happens is basically what you can see here. Let's try to look into this formula, which is really a formula for disaster, in some more detail. If your growth slows down and you keep spending according to your original plan, it's quite obviously that you have a higher burn, shorter runway, less ARR, less investor interest. And in a red-hot VC market like the one that we had in 2020, 2021 in particular, you might still be okay, or you might still get away with this. But in a tougher financing market like the one that we've entered a couple of months ago, this is a huge problem. In the best case, if you have to raise in a situation like this, you might have to raise at a much lower valuation than you were hoping for. It might even be a down round. In the worst case, you can literally go bust. Let's try to dig in a bit deeper here, how does it work, and what are the mechanics, and how can you diagnose the problem and what you can do about it. We're going to look at an imaginary SaaS company, obviously called Acme, and I'll show you the projections of this company. The company is at $4 million ARR. They've recently raised $12 million in venture capital financing. The plan of the company is to triple ARR to 12 million ARR in the next 12 months, and then to continue to grow very fast and reach $19 million of ARR 6 months later. You can see the ARR projection here, and on the next chart you can see the cash flow projections. Green is cash coming in, red is cash going out, and the red line is the net burn. And here on the top right you see the bank balance as a result of this. It looks pretty good, at least based on this plan. The company has about 18 months of runway, which maybe sounds reasonably good. But now let's fast forward 6 months and see what happens. So 6 months later, the company has been doing pretty good, didn't quite hit their plan, but pretty close. So they've grown from 4 million to 6.2 million in ARR, which is, as you can see, it's not quite, it's not 100% plan achievement, but it's pretty close. If you look at the cash flow chart here, you can see the actual really not a hugely visible difference that you can see here, at least on the scale. And here, what happened to the bank balance. But now, the founders or the management of this company, they decided to take a much closer look, and they saw that their growth rate in those first 6 months has only been about 7.6% instead of the 9% which they were originally planning with. Which is not a huge, which might not sound like a huge difference, but because it's exponential growth and it compounds the founders realized that things aren't quite on a more conservative, more realistic forecast. And now if you look at what the cash flow projection looks like based on that revenue forecast, but keeping costs as they were, this is where things start to get pretty ugly. Because as you can see here, if you look at what it does to the balance, to the bank balance of this company, is that they will run out of money after month 14 in comparison to month 18, which they planned originally. But because they're already at month 6, they only have 7 months of runway left, which means they have to do something immediately. We can talk about some of the things which they can do to increase runway a bit later on, but the key message here is it's about time, no, definitely not a day too early for the company to see that something hasn't been going to plan, according to plan, and they have to do something. If they had waited another 2 or 3 months to do something, the company would probably be dead. You can see again, what it meant to the bank balance. So what happened? The company started out with 18 months of runway, but 6 months later, they only had 7 months left. What happened? How could it have been avoided? The simple answer is that the burn of the company was too high, that they didn't plan to have enough runway in the first place, and they should have had much more buffer. That's all true. But let's still dig a little bit deeper in here. One of the issues is that if you look at the total ARR, the delta is not very visible. Like if you look at the chart here on the left, the dark green is the actual, the light green is the original plan. It doesn't look dramatic, right? It looks like the company is more or less on track. If you look at the net new ARR, however, the difference becomes much more visible. It's a really, really simple math, but nevertheless, I think some people, or maybe many people, or too many people, don't really focus on looking at the net new ARR, only in spite of this really being the metric that gives you a better insight.
Really seen in issues earlier. And then if you look at it in a different way here, maybe it becomes even more visible. So what you can see here is the ARR at the top and net new ARR at the bottom, and it compares the plan numbers versus the actual. And then in this green, yellow, orange, red cells, you see the percentage of plan achievement. And if you look only at ARR, it's always above 90%. So you might think it's all reasonably close to the original plan. Everything is okay, let's just continue. But if you look at net new ARR, you can see that the differences, that the amount that you've missed relative to your plan is actually and really as a startup, the ability to adapt super quickly is absolutely critical, right? It's being fast in general is probably the only advantage that you have as a startup going after bigger companies, but it's also really, really critical to react quickly to a new situation, whether it's a new situation based on lower growth or something having changed in your business, or a change in the market environment, or maybe even a combination of both. And if you're not focused on the right KPIs, you will probably not be able to react quickly enough. And as I showed in this example, this can be a matter of life or death. Now, what should you do if basically shit has hit the fan already, or if you are already dangerously close to that iceberg? Well, I has a reasonably easy time raising money from investors. So we can talk about that question a little bit, like what makes a company investable. We've tried to address this question like for many years with our SaaS funding Lemkin, which maybe some of you know. There is never just one factor or one metric that makes a company investable or not investable. It's always a combination of many different things, like non-quantitative things like your team and product and market and competition and all these things. But there are also many important metrics, and the later stage the company is, the more it is about quantitative metrics like growth and churn, revenue churn, net expansion, efficiency, and many other metrics. Growth is still incredibly important, and I'm going to show you some of the benchmarks here from Bessemer's very large cloud portfolio. As you can see here, the bar is still pretty high. If you're not growing at least 2x year over year, it's pretty hard to get investors really excited, at least until, let's say, 20-25 million in ARR. If you're significantly beyond that, then obviously the growth expectations in terms of the relative growth are a little bit lower. But if you look at these numbers here, which are really from the entire cloud portfolio of Bessemer, it's not only the unicorns or the public companies, it's their entire portfolio. You can see that the bar is pretty high. So growth continues to be very, very important, but what's maybe new in this new environment is that it's no longer growth at any costs. Efficiency is important, has become more important, because growth at any cost is no longer rewarded. And so you have to try to find the right balance between growth and efficiency. And in order to measure or get a sense for your efficiency, I like two metrics in particular that I'd like to show here. One is the burn multiple, which basically tells you how much capital do I have to raise for $1 of net new ARR. So I think it's a really simple to understand and quite practical metric to keep in mind. It's not possible to tell you like what is good or what is not good without knowing a bit more about your company. It depends on the stage, right? If you're just starting out, it's normal that that value or that metric is higher, because in the first couple of years you have to invest so much in product and engineering to get things off the ground and to even have a sellable product. So it's normal that this value is higher in the beginning, and then over time you can lower it because you have some benefits of scale. As a general rule of thumb for SaaS companies, around 1 million to 25 million in ARR, which I'm assuming is probably the range most people in the audience here are in. 1.5 to 2 is good. 1 to 1.5 or even lower is great. If you're spending or burning like $3 or $4 to add $1 in net new ARR, it's probably hard to convince investors, because they will think about, like, I'm going to invest $20 million here. They are going to add only, let's say, 5 million in net new ARR, and then they think about what does it mean for the next round, and it just doesn't look that convincing then. So the burn multiple is a pretty important thing to keep in mind. The other really important efficiency measure is the sales efficiency. And what the sales efficiency does is it tells you how much net new ARR do I add for $1 spent on sales and marketing. There are a couple of related similar metrics, like the magic number, which you may have read about, or like the net sales efficiency, which looks only at net new or gross sales efficiency, sorry, which looks at not net new ARR added, but all of which looks, I'll follow up with this. I want to make sure I don't say something that's wrong. So when I share the slides, I'll add the definitions of some of the other alternatives. But the bottom line is that there are some nuances in the way you look for only like net new ARR or new ARR, or if you factor in gross profit, if you want to know your CAC payback time. But in the end, it's always about measuring the efficiency of your sales and marketing machine. And a value of 0.5 to 1 is very good. 1 to 1.5 is even better, is great. So note that in the burn multiple, the net new R was in the denominator, while in the sales efficiency formula, it's in the numerator. So for this one, you want it to be as high as possible. For the burn multiple, you wanted it to be as low as possible. It's not so important, I think, if you look at the sales efficiency or the magic number or the CAC payback time, which of these metrics is the right one depends a bit on your stage and in your sales cycle and a couple of other factors. But you have to have one metric that measures the efficiency with which you can acquire customers, and basically how long it takes for you to recover your investments in sales and marketing. Now, if we put these two metrics on a 2 times 2x2 matrix, we, I think, can make some pretty interesting observations. If you're in the top right corner here, congrats, then you're probably on a really, really good track. Everything is pretty awesome. If you're in the bottom right, then it means that your sales efficiency is very good, like very, very good, but your overall burn multiple is too high. So in that situation, you probably should not cut costs across the board in order to increase your runway. You actually have an opportunity to increase your sales and marketing spend until you reach the point where it stops to be efficient. So if you're in this quadrant, you should consider trying to cut costs in everything that's not sales and marketing, R&D, G&A, all these other buckets, and try to shift more budget to sales and marketing. And this might be a little bit unintuitive, because you might think that you just have to cut costs in order to maximize the chance of, I don't know, surviving or increasing your runway. But this isn't always the case. If you have an efficient sales and marketing engine, try to spend more on it, not less, and try to save money in other places. On the opposite part of that, if your sales and marketing efficiency is pretty low, and your burn multiple is also quite low, it means that overall you're probably doing okay, but you're wasting money on sales and marketing. So in this case, you should almost certainly reduce your sales and marketing spend, because it's just waste. And you should most likely, you probably have to let go some salespeople, reduce your marketing spend, rebuild things, learn, and once you're better in terms of your sales and marketing efficiency, then you can increase it again. You might wonder, like, if you think it's not looking great right now, but you expect it to look good, like you'll probably wonder, like, should I let go my salespeople? I think they will do well in next week or next month. I can't give you the answer to that. It always depends on your confidence that things are really starting to look better, depends on how much runway you have. But there is no one-size-fits-all solution to most of these questions. Last, and I don't know, hopefully least, if you are in this quadrant here in the bottom left, it means you're burning too much overall and you're spending too much on sales and marketing. So this is obviously a very tough spot, and if you're in this situation, you most likely have to cut costs across the board. Spend less on sales and marketing and decrease your overall burn just to ensure the survival of the company. You most likely have to accept that you're not going to grow very fast in the next 6 to 12 months, but you probably have no other choice. So if you're in this situation, you most likely have to make pretty deep cuts and buy yourself time to improve your product market fit and basically to figure things out. All right, let me try to summarize some of the takeaways from this. You can and you should have an ambitious plan, but when it comes to determining your runway, it has to be based on a more modest plan. Like this gap that increases month over month, if you don't hit your 9% or 10% or 11% month over month goal, will just get bigger and bigger every month. So if you, and it's usually, at least at a Series A or probably even Series B stage startup, you usually don't have that level of predictability. So if you're basically planning to spend money that you will only have if you hit those growth targets, it's just very, very risky. So I think you need to have a more conservative plan which you use to manage your runway. As I talked about at the beginning of the talk, you need to have a look at net new ARR, because if you look at ARR only, you might not notice that things are off track fast enough. You need to be really fast to adapt, and you should consider having a burn budget. That's something that Jason wrote about in a blog post that really resonated with me. So you're basically defining a maximum amount that you and your team know they can burn, and you just don't increase that. So if you have less revenue than planned, it just means you just can't spend more. So I think you need some guardrails to ensure that you're not running into the situation that I described at the beginning of this presentation. If you can't become default alive, then try to become default investable. And to become default investable, look at your burn multiple, look at your sales efficiency. You may want to move budget from G&A and R&D to S&M, or the other way around, depending on where on this 2x, 2 times 2 matrix you are. Or you might also have to reduce costs across the board. I have a few bonus points that we can go through quickly, and after that I'm very happy to take some questions. So I'm sure you've all read a couple of posts, or maybe many posts by various people, VCs or CEOs, operators, about ways to increase runway. I think not everything here is something for everyone. Consider it a menu of options that you can consider, and kind of try to find the right ones based on your specific company. I'm sure there are a couple of other ones, or maybe many other ones that I didn't mention here, but those are some of my favorites. I just mentioned them really briefly. You can try to switch more of your customers to upfront payments. Like if you have a lot of customers paying you monthly, I think you should try to get more of them to pay you a year in advance. You probably have to offer them something like a discount. You shouldn't do too much, but obviously there is a trade-off. You sacrifice some revenue in order to get some more cash. But if you need that cash, now is probably the time for you to do that. So that's something that you consider, and then you can obviously need to make sure that your sales team knows about it and is incentivized to collect more cash in advance. Another possibility, if you have a significant number of customers on old pricing plans and you have increased your pricing in the meantime, is that you de-grandfather them. And this might feel odd to you, like talk to customers and tell them, well, you're going to have to pay us more. But companies have done it. You have to manage it carefully. And if you need some more cash, this might be one of the less disruptive ways of actually doing it. Next point, in general, try to increase your pricing. Pricing is a huge leverage. Lots of SaaS companies don't charge enough. So increasing pricing or experimenting with pricing is generally always a very good idea. But if you haven't done it before, or if you're not sure, now is a good time. It's another reason for you to consider it. The next one, it might sound quite harsh, but every company has 5 to 10% or maybe even more of people on their team who are just not performing as well as the rest. There is just no company where everybody is at the same level. So just consider letting go like the bottom 5 to 10%. In the sales team, it might even be the bottom 20%, and you will probably not lose much in terms of output and productivity by doing that. The next one, again, it's a topic which Jason is the expert on and can tell you more about. Move on from any VP that isn't amazing. I think this advice has been given and repeated many times over, but it doesn't make it wrong. If you've hired a VP, sales, marketing, or any other function, and if he or she isn't absolutely awesome after a couple of months, then you know that you have to let that person go. I wouldn't even try to understand the excuses why he or she isn't performing. I would just judge them based on the results, because that's basically what you're paying a leader to deliver. Next point, very tactical, but most SaaS companies, or many, could get much better at collections. It might be that if you hire somebody, probably just part-time, to chase revenue from customers where they didn't pay you or credit cards failed or things like that, that person might pay for herself or himself. Next point, renegotiate with your vendors. As a SaaS company, you might have seen this from the other side already. In a downturn, everybody is trying to renegotiate like with their landlord or their SaaS vendor, so you should try to do that too. Again, it's maybe an awkward conversation to have, something that maybe you won't enjoy, but I think you can do that, and it's another way of saving some money. Number 8, if you look at your marketing spend, you will almost certainly find that the last 20% or last 10% or last X% of your spend is much, much less efficient than the average. That's just really basically quite natural and logical. You catch the lowest hanging fruits first, and then the marginal spend, like the marginal customer, is just much, much more expensive to acquire. So just by cutting like the last 10 or 20%, you can probably save some money. And the last point that I'm going to mention here is that you can consider venture debt or revenue-based financing, but it should probably be the last resort, because it'll add a lot of risk to your company. So if you do that and things don't work out, then basically the bank owns your company by the time you have to pay back. So not the best way of extending your runway in a situation where the company isn't very healthy. That's all I have in terms of slides. Thank you so much for your attention. Very happy to take any questions. And as I mentioned on Twitter, because there is usually nobody who wants to be the first, whoever is first will get a 0.9 swag package. Yeah. Yeah. And I think we have somebody from the SaaStr team, I think Caitlin or somebody else with a microphone. So,
Thank you for the great presentation. My name is Manuel from Barcelona. Yesterday we had a dinner with some SaaS founders here in Barcelona, and some of them say, listen, it seems that it's coming a disaster, no? So
sorry, I have some trouble under hearing you. I don't. Speak into the mic for everybody else, and I try to understand you too.
How much?
Could you speak into the mic still?
Yesterday we were talking with some SaaS founders about what is macro and what is uncertainty. So there are some VCs at late stage that seems that they don't know which can be the upside and so on, and they are starting to stop valuations and investments. Now they say, hey, I don't have a clear view, which will be my upside in the next round. So for the moment, I stop. This effect from top, bottom, will go, do you think that you will go from Series B, Series A, and C? What's your thought about this? And what's your thoughts about, hey, I'm investable, as you say, and I can continue in the market going to look for money?
Yeah, great, thank you. So the question was, I hope everybody heard it, like basically how do investors react to in this current environment? And basically, is it trickling through from the public markets to the later stage growth financing and ultimately to Series A's and C's? I think it is really cascading through, right? So the impact from the public markets it's been very fast to trickle down to pre-IPO financing and later stage like growth equity financing, because these types of investors, especially the ones that can invest both in private and in public markets, they will look at this delta, and for them, they will just think, why would I invest in a private company at 30 times ARR if I can invest in a public company at 5 times or only 10 times ARR? So this will be arbitraged away really, really quickly. And on top of that, some of these crossover investors who invested a lot in both private and public SaaS companies, now they see like the public portion of their portfolio like devalued by, I don't know, 2x or even more. So it means they have basically over-allocated on the private side now. So there's a lot of drama happening in the pre-IPO and growth rounds. I think it will trickle down to some extent to earlier stages, but I think it's a bit too early to tell like how much, right? I think most investors that I talk to tell me, yeah, they're still excited about SaaS, and obviously we are, but I think it will have an impact if some of the players that were so active in the last few years just go away, so it will decrease some of the competitive pressure. My guess is that we will not go back, maybe never, or maybe not for 10 years, to what we've seen in 2020 and 2021, where there was a lot of craziness, like every round being done in just a couple of days at insane valuations. So I think now is more normal than the last 2 years. And I think if things kind of stabilize the way they were between, let's say, 2016 and 2019, I think that would probably be okay for everybody.
Hello, I'm Jean-Louis from Sociable. I think, so the presentation is really great. I would say that there are many companies that are not in this type of quadrant, but they're just profitable and bootstrapping. And I think that this new period is a good moment for the bootstrappers, honestly, because most of us face companies who burn a lot, and we face these companies now. Probably the burning rate will be lower, and the competition will be probably more fair for the bootstrappers. So I can understand that for some of us it's a bad moment, but for others I think it's a good moment.
Yeah, absolutely agree. I think there are two types of companies that are in a good spot now. One is bootstrap companies, right? Because they never made themselves dependent from financial markets or investors anyway. And then on the other hand, companies that raised a lot of money 6 to 12 months ago, but importantly have not increased their burn rate accordingly. So those companies that have raised maybe 5 times as much as they wanted or should have raised, if they haven't increased their burn rate as much and they can kind of stretch this over to have a burn rate of a runway of many years, that's great. I think the companies that are in trouble are the ones that have raised a lot and then immediately started to create a huge burn rate, or companies that maybe have a high burn rate and were about to raise but haven't raised last year. But bootstrapped companies definitely can be super strong in this situation, and you can still consider raising if you want to accelerate, because you're in a great position to be. You're in a great position, make very attractive for investors, and the value of cash is actually bigger now, right? So if you can raise capital now, you can probably buy other companies and do all kinds of things.
Thank you very much for the presentation. Louder, okay. So how hard do you think it's going to be for companies that are used to have a big cash burn? So I'm just taking back this question here, and I want to know how hard do you think it's going to be for companies that are used to burn a lot of cash in order to grow, to pivot into a more profitable model?
It obviously depends, right? Depends on like it depends on why do they need so much capital? Like how do they spend it? Do they spend it on, let's say, moonshot product developments, which might be good investments that just don't pay off quickly? Or do they spend money on inefficient ways to buy customers using sales and marketing? And in that case, they should probably cut costs very quickly. I think it's not going to be easy, but it's possible for these companies, right? And the sooner you react, the better it is, because every month you wait reduces your runway, and it means that once you do pull the plug on some of these things, it'll just become harder and harder. But I mean, there have been, I know, probably thousands or tens of thousands of cases of startups going through a phase like this, and maybe laying off 20% or 30% of their people and downsizing, and that came out as healthier companies after that. So I think this is definitely possible. This is not a death sentence, but it requires really fast, decisive action and doing things that are probably amongst the least pleasant things that you can do as a CEO.
Julia, and I'm a UX designer in Wright. And I'm wondering, you were mentioning in order to increase the runway, you can switch the payment model from going from monthly to annually payment, right? I'm just wondering, what's your experience in doing that? Isn't it something that can backfire, that people wouldn't sign up for products?
It depends on your customer segment, right? Like enterprise customers are totally used to paying annually, and they even want that, right? They don't want to deal with having to pay something on a monthly basis. If you're targeting SMBs, they might prefer to pay you monthly, but they might be okay to pay annually too. And if you give them an incentive like 1 month for free or 10 or 15% discount, they might actually like it. So I think there is really no risk in trying that. I'm not necessarily saying you should force everybody. I think you should try. you should give your sales team the right incentives, you should give your customers the right incentives, and then I'm pretty sure that a certain percentage of your customers will make that switch. I think it can be 5% or 30% or 40% or even more, right? It really depends on a lot of factors, but I think there is really no risk trying that.
Hi. Hello. I'm Leopold from Evina. Thank you, Christian, for the presentation and the blog post as well. Always super useful. My question is with regards to the burn multiple and this kind of indicators. And what, in your opinion, is the right time frame to use when you look at those? Because, for instance, if you hire, sales in an enterprise environment, it takes a while for them to ramp up, and so your burn is going to mechanically increase before it stabilizes and then decreases, And so, if you look at just 1 month or a quarter, it's a bit biased, and it can feel a bit scary, and it's actually normal. So, what, in your opinion, is the right way to look at that, both in the past and then in the future also?
Yeah, right. I think it's a very good point. Like not all revenue is created equal, right? So if you're selling to enterprises and you have a low churn rate, you might even have a strongly positive net dollar retention rate. So $1 of new ARR from an enterprise customer might be worth $1.20 next year and $1.40 the year thereafter. And that definitely means that you should want to spend more on acquiring that customer, right? And you should be willing to accept a significantly lower sales and marketing efficiency. So maybe you're saying that 18 months of payback on that customer is fine because you know that you have this amazing net dollar retention. I guess the only caveat here is, can you do it? If you're running out of money in 6 months, then you probably just don't have the choice, and you have to do things that are really focused on more short-term results. So I think if you're like early enough in your planning cycle, you can kind of think about these like longer-term investments, but there might be a situation where you just have no choice but optimizing for the short term.
My name is Rahul, forecasting.ai. One question that I have is basically during this slowdown in the VC market, how is it going to affect companies with high R&D expense? Now, what I mean by R&D expense is we are a deep tech company. This means that we have to have an R&D budget, which we can't cut in a short period of time. So what's your perspective on, let's say, AI-based SaaS companies during this time?
Yeah. Hey, thanks for the question, Rahul. I think, yeah, that's a good question. I think it's a bit too early to tell, right? Things are really moving very, very fast. And today the market is maybe already different from what it was 2 months ago, and it might still be different in another 2 months. I think pre-seed or seed companies will still be able to raise significant amounts of money, like let's say $5 or $10 million if it's the right team and if it's the right opportunity to do that R&D work to get a product into the hands of customers. So basically, maybe one way of looking at it is you have this initial shot, right? You get this pile of money, but you have to do something with it. You have to prove something. And in comparison to last year and the year before, where money was just cheaper and more readily available, it's probably fair to assume that it's going to be somewhat harder. So my default assumption is just that it's comparably harder to raise for any company at any given stage, because in the last 2 years, there was just so much money in the system trickling through
to basically every bucket. So I think the unfortunate or maybe tough message for almost everybody might be that you have to do more with less. Yeah.
I'm Patrick from Motion Tools. Thanks for the presentation. You mentioned sales efficiency on the one hand and gave a really nice framework for that. On the other hand, some best metrics for growth, like what is considered good. What is like a good kind of rule of thumb on how to bring those together and say at what kind of sales efficiency is it still good enough, like the growth rate, or when is it okay to even grow faster?
Yeah. So for somewhat later stage companies, there is this famous rule of 40, which you might have heard about, which is basically you take your growth rate and you add your EBITDA or cash flow margin, which is usually negative, and then you get the sum of those two values, and if it's above 30, 40, 50, that's generally considered to be good, and if it's lower than that, it's not so good. The problem is that this only really works if you're at, 10, 15 million or so in ARR. At a much earlier stage, you will almost always have a not so good rule of 40 because the investments in product and engineering are just so high that they matter, relatively speaking, so much more. I think at the earlier stage, you probably have to wonder, what's the minimum growth rate that I need to attract investors? And then you try to get there as efficient as possible. And if the conclusion is that you won't get there in an efficient way, then you need to do something else. Then you probably need to go back to bootstrapping mode, or somehow extend your runway and assume that you're not being investable for now, and you need to kind of get back to the drawing board. So that leaves the question, what is a good enough growth rate? At the early stages, let's say below $1 million in ARR or a couple of million in ARR, I think 2.5x is probably pretty much the minimum. Definitely more than 2x. I think anything below 2x is a bad signal for investors. And even if you're at 5 or 10 million ARR, as you saw from these Bessemer metrics, it's the 2x still holds until 10, 15, 20 million ARR, where it gets really, really difficult. So the bar is pretty high there. Yeah.
Hello. So subscription is the business model that we're talking about today, but what are maybe one or two verticals that you in Point 9 find interesting at the moment?
Yeah. So at Point 9, we do primarily two things. B2B SaaS, the subscription model that you mentioned that we all love here. And then we also do B2B marketplaces. And then some of these companies do both, like what we like to call SaaS-enabled marketplaces, which can be really, really strong businesses. In terms of the verticals, which you asked about, we really, especially for the marketplace side, we really love verticals that I probably didn't even know they existed before a founder tells me about it. We're an investor in a company called LaserHub, for example, which is a marketplace for custom-made metal parts, using laser cutting. Probably none of us in the room is really has thought about this industry. I'm not happy to be proven wrong, but it's probably trillions in size, or similarly logistics, or metal trading. So there are so many companies from the so-called old economy that are working in a really inefficient way. We tend to think that every company that transacts using phones and fax machines deserves a better solution, a better SaaS solution, probably a marketplace to match supply and demand. And so we're really excited about these types of industries that are not really on everybody's mind, and where you need founders with super deep domain expertise to build a company there.
Hi, Espen from Kindly AI. Thanks for a great presentation, and I also love to read your posts.
Thank you.
And this question is because you maybe have an answer to it, apart from a lot of others. So what we have seen through the GFC and the COVID situation is that quite some customers have chosen to stick to their current vendors and rather increase their commitment with current vendors rather than having new vendors. Would you have any thoughts on, I mean, because if we're going into troublesome times, it could be harder to acquire new logos than to stick with the current customers. So my question is more on from experience with the other situations, GFC and the COVID. What was the decline in new logo retention in terms and what was the stickiness of current customers? Could be a topic for a post of yours.
Yeah. Thank you. Yeah. So I don't think I have a quantitative answer on that. Maybe if the question is like, how can you deal with that situation? I think it's maybe related to, like in general, like your product market fit and the urgency that you can create for customers to buy your product because it's much better than the competition. Which means that it's a complex topic and where the answer doesn't fit into like just a few minutes. But maybe just two things to think about. Like one is to just in a situation like this, spend more time with your existing customers so that they expand more with your product. If the behavior that you observe is that in your industry, people stick more to whatever they're using already, so maybe you can try to benefit from that as well. And then when it comes to selling to new customers, I think it's generally hard to sell to customers when they don't have a pressing need. So obviously you can do a lot of things, you can have a better sales team, better tactics, but I think the thing that probably works better is to find better leads. I think if you chase leads that don't seem to have the right urgency and they might be reasonably happy with whatever they are using and might not see your USP, it might just not be the best use of your time or your salespeople's time. So what you should maybe try to do is open up the funnel, try to get more leads, but then let your sales team be picky to focus on the leads that have the highest probability of closing. And if you don't have any of these leads, then I think it just points to a deeper problem with your product and positioning. Yeah, one or two more questions?
Hello?
Hey.
Okay, hey. So thanks a lot for the talk, it was amazing. One question, you talked about sales efficiency. So we're seeing an impact of the overall situation and environment. Also, for example, on the conversion rates, sales cycles are getting longer, acquisition costs are going up. So what's your point of view there? Like how do you think companies should adapt also to the market, behavior?
Yeah, that's a very good point, and I didn't even mention this in my talk. Like what could be some of the impacts on really the fundamentals of the company, right? It could be that customers go out of business, right? I think we're not really seeing this yet, at least not in big numbers, but especially for companies that sell to other startups, and some of them might go out of business, that could really have a pretty bad spiraling effect. Sounds like you might already see it, and maybe not in churn, but in lower conversions or lower or longer sales cycles. That's definitely not that unusual. I don't know if there is a simple way to address that, right? I think you can try all kinds of tactics to increase your conversion again or reduce your sales cycles, but at the same time, you probably also have to take into account the possibility that it'll just be like this for some more time, and then adjust to it. If it means you have somewhat lower growth than you planned, then you're maybe a bit like this company this imaginary company that I talked about that should find some ways to extend runway. But I think it really depends if you can make investments in sales and marketing, customer success, which kind of deal with the core issue. Then if you can do that, that's great. But if that doesn't work out, then you probably have to do something else to at least have enough runway. I think we're out of time. Thank you so much, everybody, for joining, also for the great questions.
Thank you all for joining me today. We're going to talk a little bit about the metrics that matter for your business. And we're going to talk about it from a context of fundraising, but what's really important to remember is these metrics should actually be the underlying force in your day-to-day operations, because they really do give you a proxy for the health of your company. So I'm going to go through 4 specific areas of metrics that I think are the most important to convey clearly as an entrepreneur. But we're also going to talk about why these metrics themselves are so crucial and why they really are interconnected into the entire company as a whole. But first I want to start with a story. So a couple years ago, I met a company that had incredible metrics. The business was 10 million in ARR. They were tripling year on year. They had 150% net dollar retention, 95% gross dollar retention, and they were burning the same amount that they were adding in net new ARR during that year. We ended up passing on the business. And this is because when we questioned the team about why these metrics were so good, they came up pretty dry. It was almost like they had fallen into these amazing metrics, but they didn't have a good conception of what drove them in the underlying way. And so what the big takeaway from this presentation should be is that it's not just the metrics themselves that matter, but it's your command and your control of these metrics that will make a big difference. And it's pretty empowering because nobody will have perfect metrics, but if you understand your own ones in a granular way, you're really well positioned to fundraise, especially in today's climate. So now let's dive into some of the key areas that are most important to understand. The first is growth. And we often get the question, how fast should I be growing? I think it must be a really annoying question. But the logic and the reality here are kind of mismatched. So logically speaking, you would expect that as a company grows linearly or even exponentially, the expectation around growth should fall at a pretty similar rate. The reality is not the case. So we'll often see founders frustrated because they think, oh, at 5 million in ARR, I was expected to grow 100%. And now I'm at 10 million in ARR and I'm still expected to grow 100%? Doesn't seem to make that much sense. And that's why it's really hard to do benchmarks around growth, because investors have different expectations and the growth rate is really taken in conjunction with the broader picture of the company. All that being said, there are a couple things that can help guide. So from 1 year after launch to get to 1 million in ARR would be considered very, very good. 9 months is excellent. This is from launch, not after incorporation. And then after that, triple, triple, double, double, double is considered best in class. But again, I want to emphasize that all of this should be taken in conjunction with the broader picture on metrics. And it's important to emphasize net new ARR. And this is what differentiates a company that's growing linearly from a company that's accelerating. So for instance, if you're adding 5 million in net new ARR every year, you're going from 15 million to 20 million to 25 million. That's a really linear growth trajectory. If your net new ARR is accelerating, and you went from 5 to 10 to 20, that company is going to have a J curve. And so you can set yourself apart as a really metrics-driven and thoughtful an entrepreneur by showing this net new ARR number when you're trying to fundraise and you're trying to convey your own growth, even at very small stages. So if you added 100K in net new ARR last quarter, and then you added 300K the next quarter, it's really helpful to show that acceleration, and it will get investors very excited about your growth trajectory. Now, the rest of these metrics are a lot more benchmarkable than growth. And so for the rest of the slides, we're actually going to see a pretty clear framework on what the expectations should be if you're selling into SMB businesses and if you're selling into large enterprises. Ooh, that's a good echo. So in today's day and age, burn is becoming more important than ever. And I think one of the most interesting metrics to track with burn is just your net new ARR divided by your burn. And some people do it the other way around. They do your burn over your net new ARR. Generally speaking, around 1 is considered very good. So if you added 500K of ARR in a given year and you burned 500K, that would be excellent. And at later stages, let's say you added 15 million of net new ARR and you burned 12 million. That would be very, very good. Hyper-technical products are held to different burn standards. And so if you're an entrepreneur and you have a really interesting reason why your burn is so high, you should absolutely convey that, so that at least there's understanding for why the burn metrics might be slightly different. And then on cash runway, this is something that's changed a lot in the last couple of months. So in 2021, it was grow at all costs, party season, super fun. And we were typically advising companies to have about 12 months of cash runway on hand. Fundraising environment was very different than what it is right now. So we've adjusted at Index our own guidance around this to extend runway as much as possible, ideally to 24 months, which should give everyone enough time to ride out different market fluctuations and continue to grow and optimize other metrics as well. But when it comes to burn, what you really want to think about is the end state business that you're building. So it's one thing to look at the burn metrics on a given quarter or on a given year, but many investors, particularly at later stages, want to see a line of sight to 20 to 30% free cash flow margins. And that may seem like a really far off milestone, but it's about understanding the business model itself and making sure that that business model has the potential to someday be very profitable. Now, a couple of bootstrapped businesses have shown really clear examples of how to grow really fast while not consuming a lot of capital. I'm going to give 2 examples of businesses that do the same thing and have had different ways to grow in a bootstrapped way. So one is here in Barcelona, Typeform. They make survey software. And Typeform was bootstrapped for a really long time before we at Index invested in them. And their unfair advantage, their reason that they were able to grow so profitably, was in many ways due to the product design itself. So Typeform is really beautiful. If you've taken a Typeform survey, you might think, oh, this is pretty nice. I'm going to send this to somebody else. And that's exactly what happened. They had a lot of organic virality, and so they were able to self-fund with their revenue for many years. There's another company in the United States called Qualtrics. They do the exact same thing as Typeform. It's really modern survey software. Qualtrics took a different approach to growing while bootstrapped. They gave out their software for free to university students, and university students would use that to do a psychology study or any kind of survey they were running on campus. And then those university students would graduate, and they would go off into McKinsey or Procter & Gamble, and they already knew how to use Qualtrics themselves. So 2 companies doing the same thing, using very different strategies, very different unfair advantages, in order to manage burn while growing rapidly. And that's one of the main messages from today, is find your own unfair advantage across any of these metrics that you can exploit and you can convey clearly to investors when they ask you, why is this metric so good? What have you done right? But the last point about burn that I'll make is that if someone tells you to grow faster while burning less money, I think you're completely within your right to give them this face. So you have your customers, you're growing as a whole, but the holy trinity of these retention metrics is the most important part of, one of the most important parts of an investor's analysis into the health of your business. And I call this a holy trinity because I don't think any of these metrics on their own, individually, are particularly interesting at all. They exist together, and we often see entrepreneurs and founders not even cite metrics like gross dollar retention, which I think is really selling themselves short. So logo retention, of course, is the most basic measure of retention. How many customers do I have today relative to where I started the year or the quarter or however you measure it? Gross dollar retention is the same thing, but it's with the dollars spent, the total revenue versus the number of logos themselves. And these two together are really interesting. So for example, let's say you have gross dollar retention that's higher than your logo retention. So your gross dollar retention is 85% and your logo retention is 70%. So not amazing. What this can tell an investor is actually that your larger ACV contracts, your bigger dollar contracts, are sticking around more than your smaller ones. More logos have churned, but you're still retaining that revenue. And that's really important to know, and actually can be really helpful in giving a lot more confidence into the business you're building. On the flip side, gross retention and net dollar retention together can also be really interesting. So let's say you have incredible net dollar retention. You have 160% NDR. And then your gross retention is 60%, 70%. What that tells an investor is that some of your customers are doing exceptionally well with your software. They're upselling in a massive way. But others are not having product market fit at all, and they're falling off. This is really good to know. It's a proxy for product market fit. It's a proxy for market size even, because it tells you that only a certain subset of customers really are finding use in your product. So these three metrics exist all together, and they're really, really important to convey when you're talking to investors and when you're managing your business as a whole. And actually, Tomasz Tungus did a really interesting study on net dollar retention, which I found fascinating, where he looked at a company and held everything else equal besides net dollar retention. And he just changed NDR from 160 to 120. And when the NDR was 160% versus 120%, the company grew 4.2 times over a 5-year period. So it shows the power of net dollar retention, but what I would say is don't forget about gross dollar retention because it's really important as well. The last point on this is we sometimes get the question, when should we show cohort retention? And it can be a little bit confusing because these three measures are all measured on a trailing 12-month basis. And then some people go off and show the cohorts, and I understand why it might be uncertain when to use which. For enterprise software businesses, I recommend that you show cohort-based retention if you've had time-stamped changes. So for instance, let's say you made a big change to your product in September of 2020. And after that change, you've seen cohorts perform at a much higher level than earlier ones. Give yourself credit for that improvement and show on a cohort basis how those cohorts have stacked and improved over time. If you haven't had major changes, your trailing 12-month retention and your 12-month cohort retention are probably going to look very, very similar. So there's no need to show both. So I want to talk about sales efficiencies, but first I want to tell you about a bathing suit that I recently bought. So I had seen this bathing suit on my Instagram, I think like 11 months ago, and it was really cute. I liked it. I saw it again on my Twitter a couple months later, and then I saw it again on my Instagram, and I logged into Facebook for some reason. I saw it there. Months and months go by. It was winter in London. I wasn't buying a bathing suit. And finally this May, I sucked it up, and I bought it. I got it on a bit of a discount. I'm probably never going to shop at the brand again. And this is a really good example of terrible sales efficiencies. The amount that this brand spent to acquire me as a customer was probably in the hundreds of dollars. And yet I bought a $50 bathing suit, and I'm probably never going to buy from them ever again. Now the same goes for sales efficiencies in enterprise software businesses. You want to make sure you're really understanding the LTV of your customer and the cost that it takes to acquire them. Now, there are a lot of metrics around sales efficiencies, and sometimes it can be like alphabet soup. The two most important ones are CAC payback period in months and 3-year LTV to CAC. And I argue this is the case because for CAC payback period in months, you get a really clear understanding of how quickly it takes to pay back the cost of acquisition, and therefore, how quickly you can acquire many customers at scale. But CAC payback period in months is only one part of the equation. Because when you're saying, okay, it took me 12 months to recoup the cost of acquiring that customer, you're not really seeing what that customer does after you've already reacquired that cost. So let's say it takes 12 months to acquire a logo, but then in the next 2 years, they upsell and they upsell again and they upsell again. You want to show the 3-year LTV to CAC or even the 5-year LTV to CAC in order to give yourself credit for the amount of LTV that's generated after you've already paid back that customer. So I think it's really important to show both of these metrics. And there are a couple examples of businesses that have really optimized their sales efficiencies metrics by, again, utilizing unfair advantages. So I'll give you 2. One is a business called Paycom. And Paycom sells human capital management software, not the sexiest product, lots of companies doing that, and really hard to make those sales. So what they did was pretty inventive. They took their sales rep model and threw it out the window. And instead of hiring experienced reps from other companies who had sold that kind of software before, which you think would be pretty rational, they instead decided to hire people with no sales experience whatsoever. They took these people, they gave them a really strong training playbook, and then when they opened up new geographies, they would put little SWAT teams of these people in the new geos. And this worked fantastically well for Paycom. They were able to scale their sales organization in a very efficient way, and their CAC payback period in months is still among best in class when you look at publicly traded companies. A very different unfair advantage is a company called Veeva. So Veeva sells software to the life sciences and biotech company. They sell compliance and CRM software. And their unfair advantage, their reason why they were able to achieve such strong sales efficiencies, was in many ways because of the vertical market they were in. And this is one of the advantages of vertical SaaS businesses in general. They have a really defined sales universe where people talk. So they got a couple of key logos using their platform, and then all of those businesses went and told all their other friends in the life sciences world how great Veeva was. And they optimized on expansion in order to optimize their sales efficiencies. So their LTV for these customers was massive when they layered on additional products and continued to upsell them over time. So 2 very different routes to getting strong sales efficiencies, but both very effective. And then finally, what about everything else? So these 4 areas, growth, burn, retention, sales efficiencies, are what I think are the most important to clearly convey. But there are plenty of other metrics that are really important to show as well. So first of all, company-specific metrics are fascinating to investors. What your North Star metric is something that we always want to see, and how you're managing to that metric over time. But also things like gross margin, NPS, ACVs. And particularly with things like gross margin and NPS, it's really helpful to benchmark for your own market. So if you're selling customer support software, which has historically really low NPS, but you're crushing it, and your NPS of 10 is way higher than everyone else's negative NPS, show that, and give yourself credit for that strength. Gross margin is another one that's really interesting. When we invested in Revolut, they had a negative gross margin. And it was something that we saw the founder be really attentive to over time. And he made decisions over the recurring years that helped push this margin up to the place where it sits today. So improvement is possible for any metric if the founder or the team has a command and control and visibility into what those metrics look like. And then ACVs, just a quick note on this. There's a common misconception that 30K ACVs are the valley of death, and that no big businesses have been built with 30K ACVs. I think this is absolutely wrong, and we have plenty of examples now, Avalara or even like OneTrust being examples. And so there's no right answer with ACVs. But showing that progression again, whether you're moving up market or whether you're moving down market and have a really good reason for moving down market, that can be really important. And then finally, investors are used to receiving data in relatively similar ways. And so it's helpful to avoid things like cumulative data, which are not normal for us, or not typical for us to read. And try to just demonstrate your metrics in the most clear and concise way as possible. A couple of key takeaways from today. One is that strong metrics typically reflect some sort of unfair advantage. Whatever your unfair advantage is, understand it and convey it well. And there's no right unfair advantage. It depends a lot on what others in your market are doing. The second is that all metrics are interconnected, and some can supercharge more than others. So many investors, typically at later stages, will end up building a model based off of the metrics that you provide. And this model is really just putting everything into one unified data format and then playing with different assumptions. And in these models, you can see really clearly how the metrics all work together. And some, like I would argue gross dollar retention, which is my favorite metric, can really supercharge your business more than others. And finally, nobody has perfect metrics. And so there's no expectation that every number on the page is going to look a certain way. But what you can do is have a thoughtful action plan around how to improve certain metrics, and you can have a command and control over your own organization through your metrics. Sometimes I think that being a founder seems really daunting. Investors seem to have all these expectations. You have to grow quickly, but don't burn too much money. You need to have really strong net dollar retention, but don't have too long of a CAC payback period. There's a lot going on. But what we've seen time and time again are entrepreneurs who embrace this uncertainty, embrace this chaos, and they manage to get a command and control over the metrics in their organization. And there are tools that can help with this. So first of all, there are tons of blog posts about SaaS metrics, many of which I consulted for this presentation. There are also dedicated SaaS management vendors that help you integrate all of your data and show it in a really nice, clean way. I think one thing that's even more challenging than just wrangling your data or putting it on a slide, though, is building an organization that's oriented and aligned around metrics. It's really a cultural problem at the end of the day. And so for that, there are companies like GTM Hub in our portfolio, which is OKR management, that gives everyone on the team a metric that they're accountable to and shows across the entire team how these metrics can sit together. And also just provides the visibility for upper management into how the team is tracking towards the various metrics that will end up driving the health of the business. So with that, I want to open it up to a couple minutes of questions. But thank you so much for the time and attention, and I'll be here afterwards if we want to chat more. Let's see. Yeah, so the question is, why is gross dollar retention my favorite metric? So if you look at the logo retention on a given year, let's say you start the year with 100 logos, and then you end the year with 92. You'd have 92% logo retention. But it doesn't tell you anything about those logos themselves. I don't know if I lost 8 self-service customers that were barely paying anything. They could have been paying $1 a piece. I'd have no idea if I only saw the logo retention. If I see the gross dollar retention, you're saying at the beginning of the year you had $100, at the end of the year you had $50. Jesus Christ, you know, there's a lot of big customers that are leaving my platform. And so when you have them together, you have a really nuanced understanding. And if you have both of those metrics, you can see, okay, I lost a certain amount of logos, but looks like they were pretty small and I still retained most of my dollars. Or maybe it's the opposite. Maybe I have still a 98% of my logos, but that one logo I lost was 40% of my revenue. And so having these two together is absolutely crucial, in my opinion. And it's criminally underrated. You would be really surprised how few people ever cite this metric, when I think it's one of the key underlying drivers of business health.
Hello?
There.
Yeah.
There's a mic. Oh, yeah.
No worries. Yad here from Penny Software. First of all, thank you, Molly, for the presentation. Straight to the point. I have 2 questions about ACV. The first question is, in an enterprise business, it's typically we look at ARR, but in enterprise software, ACV is very important, right? So my question is, if we consider ACV, ARR plus customization and implementation fees, if we look at the cohort, like a cohort of a year, what is the healthy ratio of AR to ACV? Like, say a company that has an ACV of $1 million for the year, 800,000 of it is ARR and 200,000 is other fees. So 80% of the ACV is ARR. How would we benchmark that to the standard of the market from the eyes of the investors? And my second question is about TCV. Is TCV a real metric or a BS metric?
Very good questions. On the first, I'd say 80% plus would be a good benchmark. Anything below that, there should be a really clear reason or a really clear understanding for why that is the case. TCV is a very good question. I would say don't overemphasize TCVs. Investors have began to take this with a grain of salt, particularly in today's market. Nothing is for sure. And so if you have a $5 million 5-year TCV, you can also just refer to that as a 1 million ARR contract. And of course, giving yourself credit for that TCV and mentioning it as well, but not necessarily building your entire future business off of these contracts, which may or may not break over the coming years. And having a real humility and clarity in that is something that will really impress investors, because they're probably thinking it. And if you as a founder say, it's a 3-year, 3 million TCV contract, we're acting like it's a 1-year, 1 million ARR contract with some upside. They're going to say, this person's got a great head on their shoulders.
Hi, this is working now. Yeah. Hi, we're actually an index company. My name is Xenios. I have 2 questions actually. One is, when you talk about new ARR, are you referring to new customers or new ARR from upsells as well? And then my second question is, as in our case at Desk, we have 2 sources of revenue. One is SaaS licenses, but we also, because we do payments, we have a transaction fee that we charge, and it's actually 50-50 right now. So big debate in the company is, do we treat benchmark metrics, total revenue, or do we strip out just the license revenue, which is tricky because from the customer's perspective, it really is coming out of the same budget. So we're debating whether we should just benchmark on pure SaaS revenue or bundle it all together. And so, well, we do both actually, but I'd like to hear your opinion on what you would advise.
Yeah, really, really good question. So when it comes to net new ARR, the calculation that investors will make is new plus upsell minus downsell and churn. So it's inclusive of all of the movements, all of the revenue movements of that given time period, that given quarter or that given year. And so that's why it's a really helpful metric, because it kind of cuts through all of the noise and says, well, what did we add? What did we lose? This is where we're at. And then when it comes to your second question, so there's a lot of nuance around companies that have kind of dual business models like yours. And sometimes we see things like reoccurring revenue cited in a pitch deck, or gross revenue run rate, and things like that, things that aren't necessarily ARR. And ARR is the most easily benchmarkable one. My advice, if your business model is a little bit more complex and has multiple components, is just to show it exactly as it is. So if you're showing a graph and half of that volume, half of that run rate, revenue run rate, is from true ARR and half of it is from payments volume, split that out so that there's nothing left for the investor to discover or find out in diligence. And there's no wrong answer. I don't think anymore that investors are so myopic that they're only valuing companies based off of ARR. You will get credit for those alternative streams of revenue as well, but it's important to clearly label it and not try to make it into ARR when it's not actually ARR. And the good thing is you don't have to. I mean, we're seeing payments businesses being valued at extraordinary levels, maybe not as much recently, but we're seeing payments revenue have a moment in the sun. So there's no need to force everything into an ARR framework if it's not really ARR. And I think maybe I have time for one more if there's another question.
Thank you for the great presentation. It doesn't matter too much, but I wonder if you have any best practices in tools or how you want to track these metrics.
Yeah, it's a great question. I like SaaS Optics. SaaS Optics I think is pretty good. There was another one. And then on the OKR side, I'm completely biased because it's one of our investments, but GTM Hub is amazing. It basically makes it so that everyone in the organization has a metric. The management decides what metrics are important, and then the individual also decides what metrics are important. They have kind of like a checklist for how they can get to that metric. And then if you're the management team, you can see across your entire organization for every functional area how those metrics are faring and how each individual person is faring in their quest to achieve XYZ metric. So I think they're amazing. We did a big survey of the market and found them to be the strongest. But there are also some really good Excel templates that you can find online if you're looking for something a little bit lower cost, especially for like bringing your raw MRR data into a more readable format. There are some pretty interesting Excel templates for that. And there are also some lower cost providers that are just kind of more bare bones getting you to that pitch deck. Great questions. Thank you all for joining. We have a diversity brunch that starts at 11:45, so maybe we'll see some of you there.
right. Hello, hello. Can you guys hear me? Vicente? All right. So, Manel, lots of familiar faces. So thank you very much, SaaStr, first of all, for inviting us to be here. Let's just do a quick introduction first. I'm joined by Sophie Chesters.
Hey everyone, Sophie, CMO. I have been in marketing for about 20 years. About half of that has been in SaaS, a couple of big companies, Medallia, Google, and in addition to helping UserZoom scale to 100 million ARR, which we're nearly there, I've also advised and mentored some very early stage startups, which was a huge ton of fun for an incubator. Alfonso.
So my name is Alfonso de la Nuez. In Spanish is Alfonso de la Nuez. Since we're in Spain, I have to say it in different ways. I'm the co-founder and proud co-CEO at UserZoom. And we're here to share some of the lessons learned in the last few years. I have to say, first of all, how amazing it is to be here. Because I live in the San Francisco Bay Area, and I think I attended the first SaaStr event in San Francisco about 10 years ago. And I was sitting there listening to people just like me today, and just admiring what they were saying and dreaming about doing what they were doing and scaling the business and all that stuff when we first moved to Silicon Valley. And here I am today sharing this amazing story with you all in my home country. So ask me how I feel about that. Pretty emotional. It's a dream come true, and also I'm very happy to be here sharing this story with you, because I really believe that, first of all, I know that I think about 80% of the companies here are sub 10 million and trying to make it, obviously trying to scale. And I think that all entrepreneurs, we need to help each other out. I got a lot of help in Silicon Valley when I moved there to try to get to 10 million and then past 10 million. Never thought I would get to 100, but I got a lot of help. And SaaStr was actually phenomenal and super inspirational. So, a couple minutes on UserZoom, I guess. Who are we? What do we do? And how do we get to 100 million? UserZoom, offers user experience research and testing for companies to optimize all digital products, digital experiences, whether it's websites, mobile apps, internets, prototypes, mock-ups, whatever. And what we do is we enable customers to run efficient, cost-effective user research, usability testing, user experience. We help designers, we help researchers, we help product leaders optimize their digital products through insights with real users. This is a market that back then when we started, and I'll talk about this quite a bit today, it was not a really big market. It was a niche market, but it's become now sort of the way to build new software, the way to be customer-centric in everything you do. And as we'll speak about today, there's plenty of real financial ROI behind what we do, and this has been key for us to get to 100 million. Anything you'd like to add about UserZoom? And
the odd thing I'd add is it's I've worked at some great companies, and just it's amazing when you can see the impact of what insights can do, for founders and people building products. So why don't you tell your story?
Yeah, so we started in Spain, Barcelona. We have about 130 people, I think, in the office here, and growing. I'm actually from Madrid, Spain, but we spent quite a bit of time between Barcelona and Madrid. And right away from the beginning, I moved to Silicon Valley to roll out the US market, because we're talking 2008 or so, and we had the big crisis back then. So we thought that the Valley and the US would be the market to go to. We bootstrapped the business, by the way, as I'll mention in a minute. And then after a very tough 5 to 7 years, we finally started taking off, and the company finally raised some capital in 2015. Again, I'll tell you all about this later, but it's a beautiful story, I think, of a company that starts in Spain, starts humble, starts with very little resources, and then moves to the valley and becomes a large company. We raised a $34 million round in 2015. Then we raised a $100 million round in 2020, right in the middle of the pandemic. And then about a month ago, we closed a deal, a strategic investment, a strategic growth investment with Thoma Bravo, which is one of the top 3 software companies in the world, with a valuation of $800 million. So great story. Thank you. So again, I'm just super excited to tell you guys the story and talk about these 10 lessons learned. Let's start with falling in love with the problem. So even last night, we had a nice dinner and we were talking about, oh, you guys created a category here, right? And I said, no, not really. This is not a creation of a category. This is more of a disruption. And I think that all founders, we should look at what we're building and what we're doing and think about it. Is this something that we're disrupting, or are we really literally creating a new category? If you're creating a new category, good luck. It's very, very tough, and you're going to need a lot of capital, probably, and a lot of time, and you're going to have to convince the market. If you're disrupting, like we did, we basically went and cloudified the lab, right? All the studies and all the testing that we were doing before UserZoom was done manually in a lab with a one-way mirror. How many of you guys have participated in a usability test? Yeah, quite a few. Okay. My mission will be that all of you will do it sooner rather than later. But we were basically disrupting that market. Instead of doing it in a lab, in a physical and manual, labor-intensive way, we cloudified it, and with the software that we created, we automated the way you do user research. So we were really disrupting. The other point is, as entrepreneurs, we have these ideas, right? We're so happy and we're so enthusiastic about going on your own and building your own business. Is it a genius idea that we have? I had plenty of ideas before UserZoom, by the way. Or is it really a problem? Are we really solving a problem for customers? So I would suggest that you do some serious research. I got to be honest. The way we learned about the market and the gap in the market was through our previous startup. So UserZoom is our second startup. The same co-founders started UserZoom, but also started a consulting company. And it was through the consulting that was about 7, 8 years long. That experience helped us understand that there was a real gap in the market. Companies really wanted to get insights and feedback from users and from customers. However, it was so time consuming and so labor intensive that only a handful of companies were able to do it. And by the way, they actually wanted to do it on a more ongoing, continuous basis, but it was impossible. Just too much money, too much time, impossible to meet the agile development demands and requirements. So we thought about, hey, if you put together a software and using the internet, you can connect users remotely, so you don't have to bring them to the lab. Maybe what we can do is we can get more scalability, cost effectiveness, and then actually run studies on a more ongoing basis, which is what's happening today. Our customers are running 300, 400 studies, actually sometimes less than that, maybe 50 to 100 studies a year. That's still a lot of research, a lot of tests. And if you look back a few years ago, they were doing maybe 4, 5, maybe 10 per year. And so now they're making decisions, they're considering user feedback when they're designing, when they're developing, they're reducing the risk of developing the wrong thing, which again, we'll talk about later in the benefits of what we do. But again, falling in love with the problem means really understand what the problem is, rather than just follow your gut. As entrepreneurs, we all have to follow our guts and our instinct, but if you can conduct serious research, we did it through the previous startup. But if we hadn't had that startup, to be honest with you, I think we wouldn't have had as much understanding of what the problem was. This is one of my favorites. So I think the reason why UserZoom has been successful. I mean, it took us a while to get going, but honestly speaking, you have to pick the right partners. So I get asked quite a bit, hey, how did you find your founding partners? How did you meet them? You know, and the fact is that we actually met at the same consultancy, and we worked together in several projects. We got along really well, and I think is the reason for success. At UserZoom, we had 3 co-founding partners, and we kind of had our roles and our tasks clearly divided. I read this book that I'd like to share with you guys, the Rocket Fuel VI, Visionary Integrator Combo. When I read this book, I was like, that's exactly what we were doing and what we needed also to scale. Somebody, maybe one of the founders is more of the visionary, the kind of crazy dude, kind of the Steve Jobs, more social, more sales-oriented, you know, can sell the story in an elevator, right, to anybody. But then there has to be the other aspect, which is, you know, you also have to be able to run it efficiently, run it effectively, and also, you know, have some financial skills as well, for instance, right? So this VI model is what we had at UserZoom. We had a third partner who was also a product guy, and you know, I think we set the expectations clear from the beginning, who was going to do what, and don't underestimate culture. So to me, culture is, well, as Peter Drucker said, culture eats strategy for breakfast, right? So don't underestimate the importance of the three leaders in our case, or the leaders of the company, or the leaders of the startup, setting the culture. You're going to be setting the culture for the whole company, and it's really all about your responsibility. So if you find the right partners to start up, that's going to be much easier. You want to take this one?
Yeah. So you found the right partners. You've got your problem, a genius problem, thought up by Alfonso. So what do you do next? So you may have heard this before, but we think this is still really, really important to think about. And it's to define one persona until you scale. And as a CMO, I just love to hear a founder give this advice, because it means that a marketer and the product developers can focus on a problem, can focus on those pain points. They can do that deep research and maybe apply something, a model like, you know, I like the jobs to be done model. I think that's a very smart model to use, and to really make sure that you're nailing those problems. Now, I have to tell you, there's a confessional here I'm going to make on behalf of Alfonso. He did none of those things until he met the man on this slide. So, what Alfonso actually did is took the physical business and launched a SaaS business based on what he thought he knew with his co-founders. And then went to this course at MIT with Ken Morse and realized the power of focus. So we were actually discussing at dinner last night. Alfonso had that kind of happy, sad problem where they were making money, they were taking money, they were paying the bills, but they could have been taking money from anybody because they didn't have that clear target persona. So then this happy moment, I think, would have been when Alfonso told me he had PayPal, who wanted the team to build 80 features in order to renew.
80.
He also had a major bank that wanted him to build on-prem, and I'm sure you had a bunch of other customers asking you to do all of these different things. Now, without focusing on that one target persona, it would be very difficult to decide where the next piece of revenue is going to come from. Now, I'm going to give you the end of the story, and, you know, luckily, Alfonso decided to take the UX researcher persona, which was the PayPal option, and, you know, built, I believe, 79 of those features, and that enabled the team to go and sell the same proposition to people like Google, Facebook, Amazon, eBay. So all works out well in the end, but that focus on the persona is what helped drive that decision.
Yeah, now, I'll be honest with you. This guy here is Ken Morse from MIT, and actually was here in Barcelona. I don't even remember the year, but it must have been 2010 or near that year. We weren't really sure who our target persona was. I'm sure many of you are thinking the same thing. Is like, do I go to the enterprise market? Do I go to the SMB? Do I start with SMB and then start going up market, or the other way? Typical question. We had it as well. I'll be honest, we weren't sure, and we weren't really focusing on one. And this is what we learned from this course, from Ken Morse, is focus on only one. Now, it's easier said than done, right? You're taking some chances here because you're going to have to be very disciplined and say no to potential options. And when we're starting up, we need money from anywhere, right? We're looking under the stones, you know, if there's any money out there, and we're going to say yes. And I remember that, you know, we would go and answer the phone or you know, provide a service to any company out there that would pay us, you know, a few thousand euros to start with. But actually, it was this course that I remember the three of us going back to the office and saying, you know what? Let's just focus on those guys, the PayPals, right? Let's focus on those large enterprises. And we started doing more research, as I say there, you know, to understand the pain points. These guys had, you know, multiple web properties. They had the budget, and most important, for them to improve user experience and, you know, conversion ratios of 0.01% meant potentially $1 million, right, or even more. So therefore, they were happy to pay us, you know, 50,000 or 30,000, I think is where we started, 40,000 a year, which we thought was quite a bit. But honestly, I think the lesson for me was that we were going everywhere, and we didn't really pay much attention to, you know, focusing on one specific persona. And I think that once we learned that, we were able to focus, as I say in the last bullet point, you know, give it a chance and then iterate. We worked with PayPal quite a bit, but you know, we didn't just work for PayPal. We thought that whatever we were doing for them was going to you know, work for others as well. All right, so funding, and of course, SaaStr has been phenomenal when it comes to content around funding and VCs and uniting the community of entrepreneurs and VCs. And so I say be creative when it comes to funding. Personally, you know, maybe it's because the two startups that we created, you know, we did not use VC money. We bootstrapped them. Of course, it was hell and back several times. It was really hard to do. But I really believe, and you know, when we went to the Valley, by the way, we didn't go to find capital. We went to the Valley and we went to the US to find the market. That's where our customers were, like PayPal. And we did have conversations with VCs. But the fact is that, you know, you have to be ready. I always say, get some traction, get some metrics, really understand the problem, as I said earlier, and try to get that seed capital. Wait as much as you can. In our case, we waited for 7 years, guys. And I can tell you, you know, honestly, you know, we were past the $10 million mark, and we had only raised, I think, 1 million, 1.5 million more or less between, again, friends, family, and fools, bank loans, government grants, customers that were paying for some services, which I'll talk about in a minute. We were very creative, very resourceful. This is much more, I guess, typical here in Spain and in Europe, where capital is not as abundant as it is in the Valley. But we got going. And you know what? Once we passed the $10 million mark, VCs were pitching to us. It was incredible. You guys are past $10 million in a growing market and you're EBITDA positive. They were pitching to us. I'm not lying if I tell you that we were able to raise $34 million, and we actually didn't really pitch. We talked about our story, we showed them some numbers, and we got some offers, and we ended up partnering with the right partner. I'll talk about it in a few points here, but we did it without having to pitch, you know, the typical story of the entrepreneur going out and pitching 50 times. We didn't. Our way was different. We focused on the business, we focused on growing, we got traction, and we waited for the right time. To me, VC is money that is more gasoline to an already burning fire. If you're not burning, if you don't have something going on, I think it's the wrong thing to do. So be creative. There's multiple ways to do it. One of them was, in our case, this is also something that a lot of people have asked me about. So we chose a model of being a SaaS business, right? A software as a service, but they call it SaaS++, when service actually was about 50%, at some point even higher, you know, meaning professional services, not just selling licenses or subscriptions, but actually delivering a service. And this actually worked out really well for us. The customers were getting true value and they were getting exposed to what they could do. And then I remember it was Google that came along and said, hey guys, you're really good consultants or researchers, or you're providing us a great service, but we'd like to have the keys to the car. Meaning, can I have the login and password and run the studies ourselves? To which we said, well, let us go back and think about it. It took us a year or maybe 2, I don't remember exactly, but it took us a while to go from an on-premise delivering service to a fully cloud-based, on-demand SaaS model. In the meantime, guess what? We were funding the business, right, with some services. And so it worked out really well for us. I mean, today, like, for instance, Qualtrics, which is a company that I admire, Qualtrics went public, and also before they went public, they sold to SAP for $8 billion. And when you look at their S1, they were about to go public before they got bought. They actually had 1/3 of the revenue was services. And they got an $8 billion valuation. Sometimes services, depending on where you are, especially if you're in B2B, like we were, or like we are, sometimes services can really add a lot of value, as long as you have this 75% rule, more or less. If you can demonstrate that you have recurring revenue and license and subscription to the software of 75% and 25% services, you're okay. The other thing is about making professional services recurring. So that's another thing we did over the years, is we learned that there was value, but we also wanted to make sure, or prove ourselves and prove to our customers that these services were not just like one time, maybe onboarding services in the first month or 2 months. We actually were able to define recurring managed services throughout the whole year. And as of today, I think in UserZoom we have somewhere in the vicinity of 15 to 20% of our revenue is services, and our customers love our consultants. Now, you just have to, of course, pay close attention to gross margin. I've learned that if sometimes you can actually give it away. You can give the services away as long as they support the business, the software business. Or in other cases, like in our case, we actually have a 40% gross margin. So if you deliver real value, customers are happy to pay, and as long as you can prove that there's gross margin and you're not losing money, you're in great shape being a software as a service plus company. Oh, this is one of my favorites, of course, because that's what we do at UserZoom, is we do user experience research and we empower UX designers. That's Brian Chesky, founder and CEO at Airbnb, one of my favorite companies. And of course, Brian Chesky is actually a design freak. He actually is not a business major or a finance major, or he comes from design school. And I love what they've done with their business. It's not only a phenomenal company, but it's also a phenomenal design company. And they spend a ton of money on design and research and insights. And I think that what happens when you have great UX design, and this is one of my favorite topics to talk about with entrepreneurs. Like, I would actually invest in product user experience, design, and delivering a great user experience even before I invest in sales, before I invest in marketing. I think if you can make the user experience be kind of the competitive advantage, it's going to be a great way and a very efficient way for you to grow. Look at user experience, look at product UX as not just something that's cool. Like, a lot of people confuse user experience with UI. It's not about how it looks, it's about how it works, how the website or your product actually works, and whether it's easy to use or whether it allows your users before they're customers or even once they're customers to do whatever they came to do in a very seamless and intuitive way. You'll see that companies that are actually investing in UX, and McKinsey is actually covering this, they actually outperform their competitors. Even public companies are outperforming their competitors and growing twice as fast as those that are not investing in design. Andreessen Horowitz calls this the decade of design. The 2020s is the decade of design. Don't underestimate the power and how much it's going to help you grow to have a great user experience and be the product and kind of be product-led growth versus investing in sales and marketing. And I'm not suggesting do not invest in sales and marketing. We do as well. But if you can start off with a great experience, one of the key metrics that I look at is retention. And one of the best ways to retain a customer is by making things easy and intuitive. And be user insights driven. Make decisions based on user feedback. Don't just rely on designers or developers. Listen, it's tough. It's really, really difficult to deliver a great killer digital experience. You have to make a ton of decisions. It takes a village. It's about design and development and product management and marketing, everyone getting together. And sometimes, to be honest, you have to make decisions, and ultimately it should be all about the end user, not whatever the head of design or even one of you, the founder, suggests. Should be really focused on the end users. So do user research, usability testing, and UX research. Product marketing.
Yeah, some thoughts on go-to-market. So you are in this brilliant position. You've got this great problem you're solving. You have built this fantastic user experience that people love. Now you need to get more people to hear about your product and want to test and try your product. So you need to invest in product marketing. That's probably a little obvious, I hear you say. Of course I want a product marketing team at some point. But the reason that we bring it up is because we still see early stage founders invest in growth marketing first. And the challenge with that is if you invest in growth marketing and you don't have clear, crisp value proposition and you don't have that foundational messaging done, your marketing investment probably won't give you the best ROI. So one message I want to land is that product marketers can help you stop spending money badly. They can really make a lot of other parts of your marketing, sales and marketing machine work better. So let's talk about a couple of things product marketing are great at, and then I may just talk a couple of things about hiring. So one thing product marketers, really good product marketers, are good at is stopping you talking about yourself and how great you are and how your product works. They bring an outside-in perspective to make sure all of the great stuff that you're building directly connects to the value that the customers want to hear about. And that's much more important to them than the fact that you built this thing that does that when this happens and that happens. So make sure everything you do is connected to the value and get a great product marketer to help you do that. Alfonso talked about UX and product-led growth, and of course, amazing, fantastic. But as he mentioned, some of you are going to have sales and marketing teams. Now, I don't know if any of you saw Dave Kellogg yesterday from Balderson Capital, but he reminded us of all how expensive salespeople are. So on top of their salary, there's the SDR cost. You may have SCs. And he also mentioned a number of $100,000 to generate between 20 and 40 opportunities. So if your salespeople are having trouble articulating your value proposition and linking all of the great work that you've done directly to the pain points of your users, you're going to be a little bit less efficient. And in this market, that's not what any of us want. So product marketing, foundational messaging, great for the product, great for self-discovery, and also great for your sales team. Now, one thing we love in SaaS is a marketecture. So a marketecture, one of those diagrams that explains what you do. Sometimes it shows data flows to make things really simple. They're great because in a glance, somebody can understand what you do and how your product, hopefully, how your product is valuable to them. Now, here's my confession. We don't have one at the moment, which we're fixing right now. And I actually think that we're underselling because we're getting customers come back to us with things that they didn't know we did in the first place. So very, very important, super quick read people can get if you have a great marketecture. Now, I will mention they're also great for alignment. So what people say internally quite often is translated externally. So you really want to get your marketing, sales, product, you want to get the whole company using the same terminology, the same messaging for everything that you're packaging and sending to market. Alfonso, you're passionate about this. Did you have anything to add on that?
I think you may get away with it at the beginning the sooner you can get it figured out, the better. But there's no way you can scale without it. That's how I look at product marketing and architecture and this getting alignment. Look, these are lessons that we've learned growing UserZoom. And I'll tell you, we're not the very best at it. We're learning about it. Actually brought Sophie with us 9 months ago, more or less, to work on this. And it's not easy. You know, we're now 400 people, and it's, you know, we have to do some real kind of looking at ourselves in the mirror. And some people are used to calling things one way, the other. You have to, once again, be user-centric. And the point of product marketing is to make it easy to sell, make it easy to buy, make it easy to use. Those are the three things. It's all about easy, 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 and simple. Now, it's not doing things simple when you're already at 100 million. Trust me, it's a lot harder than doing it at the beginning. So my lesson, I guess, in this case is I wish I had done this earlier. I really wish I had done product marketing a little earlier, would have built a foundation. And, you know, right now we're kind of figuring things out at UserZoom, and it's going to take a while. If we had built a foundation from the very beginning, I think we would have been better off. So do invest in product marketing.
I think what Alfonso's describing, and I don't think I heard you use this word, I know that the word technical debt is used a lot. There is such thing, believe me, from a marketer as product marketing debt. And you will get to it if you don't work with your product marketers early on to define how you're going to message, position, and go to market. Now, as you're doing this, you need to think about dumbing it down. Labels and copywriting. So labels. Let's think about features for a minute. How many features do you want to put in front of your customers at one time? You know, how many things do they have to get through before they understand the value of your product? And the reason I mention this is because it's very common for product managers, and of course everyone's very excited about all the features that they're launching. They want to name every single one. And I think there's one thing we can all agree on. I don't think there's any empty roadmaps here. You know, there is more software coming, and there will be more software coming every year. So bundling is your best friend, simple naming is your best friend, and you know, I'm going to apologize slightly, you know, maybe to some of the engineers and product folks in the room, but that's where a lot of product names start, and of course they're often descriptive, and they describe what the feature's doing, but at some point I would definitely recommend that you put them through your product marketing folks and have a strategy for how you will position a name in the future to avoid that product marketing debt. Anything else?
Let's just move on because we got about 12 minutes to go.
Oh, what next, Alfonso?
Thinking big. I can also share my personal story here. So, you know, we're in Spain, and I've lived 22 years in the Valley, and the way we think is different. And I'm here to encourage everyone to think big, and kind of really big, not just big, but big, really big. Because first of all, in SaaS, the world is truly your market, right? Here, I'll be honest, I'll tell you what our story is from a Spanish entrepreneur. You know, you have your Spanish market or European entrepreneur. You have your local market, which in our case was Spain. And you know, we weren't thinking that much about other markets. It's very typical to think, yeah, my market, my enterprises, the total addressable market in your local market or the UK or France or whatever. The way the Valley works is completely different. They don't think about California, they don't think about the US, they think immediately they want to change the world. It's a mentality rather than a place. Silicon Valley, I've always said, is more of a mentality than a place. They have the ecosystem and they're just bold about everything they do. They want to change the world. And so I remember that I got the virus, this so-called Silicon Valley virus, and you know, a lot of people were, this is 10 years ago, were kind of calling me crazy for, you know, trying to build a great business, $1 billion business. But actually, it did us well, right? So if you think sometimes maybe you know, we're being very cautious or very careful with capital, maybe we don't raise capital, and literally last night we were talking about the right balance between, you know, raising a lot of capital or not raising any capital at all. I told you the story about how we didn't at the beginning raise a lot of capital. Honestly, I think that if I could go back and do it again, the lesson I learned is that we could have raised maybe 3 to 4 years in rather than 7 years in. Because the problem with not raising is that you potentially miss opportunities, right? And so you have to find, that's why it's so hard to be an entrepreneur. You have to figure out what's coming, see where the puck is going, see, what options there is in the market, and who else than yourself to do that, right? So if you can anticipate what's coming, then that's when you can think about, hey, if I had more capital, I could actually grab more opportunities. In the Valley, sometimes what I see is that a lot of companies, because there is so much capital, they actually have this difference in terms of risk aversion, right? They don't care. They just go and take the risk. And it's a very different mentality than how I think we operate, certainly in Spain, but I think in Europe in general. And I think that if we're going to have more EU-based unicorns and references, we have to be bold. We have to think big. And by the way, I think we are much more resourceful. In general, I feel like we're much more resourceful, again, because we have less access to capital and we figure things out. But let's not be guilty of not, thinking big enough. Dreaming is free, and by having that attitude, I think is going to help you, grow the business. That's what happened to us. So I was talking about picking your right partners for startup and now for scale up. Again, that's Peter Drucker with the Culture Eats Strategy for Breakfast quote that I like so much. A lot of people ask me about VC money versus PE money, so venture capital versus private equity. Very different, very, very different. PEs typically invest in companies that are already, 10 million or bigger, and they want to, they're typically a little more conservative. They like to see, profitability, not a clear path already, a profitability profile. VCs, they really want to grow super fast and grow at all costs. Guess what? In the last 15 years or so, I've seen several stages or several moments in the market where, like today, growing at all costs does not work. If you're trying to raise money and you're burning money, it's going to be a tough one for the next few quarters. I'm pretty sure most of you are aware of what's going on in the market, and it's tough. So if you're going to pick, or if you're thinking of working with a VC or a PE, think about the market opportunity. Is it a really large market that you think you can grow fast? We're talking 40, 50, 60% or so per year at least. And there's a huge opportunity and you want to be first, or you want to beat your competitors, maybe VC is the route. A PE firm, however, is a completely different type of partner, and they're going to help you, like they're helping us right now. They're going to help you keep growing, maybe not necessarily at super hyper speed, 30 to 40% growth rate is more than enough, but they're going to help you be really good at operations. And they're going to bring a bunch of operational experience and people that have done this and been there, done that, maybe taking companies public, and they're going to help you operate. Personally, I really appreciate it. I'm a first-time CEO. I've never scaled a business like this, and I actually enjoy having some really smart people that sometimes, they're not fun because they tell you what to do, let's be honest. But very often they're extremely helpful. Culture. I don't think that you should worry. We didn't worry about valuation in all 3 rounds, to be honest with you. We didn't pick the partner or in this case the private equity that gave us the highest valuation. It's not necessarily the top priority. Honestly speaking, if you find the right, when you partner with private equity like we did, you're literally getting married and there's no way out, right? You better do due diligence. You better get to know them well. one of the best things that we've done, and advice I would give you is get to know these people for a long time. Don't just meet a few times. If you can actually meet with them, for a few years. We got to know the Thoma Bravo guys for about 4 years before we eventually, decided to partner up. So I think really is culture, and do they get you? Do they get you as a person? Do they get your market? Do they get your strategy, your growth strategy? Make sure that you set the expectations right, because you're gonna have a board, and you better be aligned with the growth strategy. And the best way to do that is by focusing on culture, by focusing on expectations and the persona. Different VCs and different PEs, they have different partners. And even the same company might have a different person leading an investment, completely different person than this other. They may be the same firm, but the partner, the person, is what matters. So get to know that person, get to know other companies that they're working with, get to know other entrepreneurs that they are backing up. It's really about culture. Just one of the biggest lessons, guys, is how culture eats strategy for breakfast. Well, last but not least, this is one of my favorites, because what I've learned over these years, guys, is that, especially again, me being a first-time entrepreneur, honestly, I'm very humble about what we've created here. I'm very proud, but I'm at the same time very humble. I've learned so much. Every single day is a new day. Every week I learn something from somebody who has more experience. You think you got to 100 million. Well, guess what? There's so many other companies that have done it, especially if you live in the Valley. And so you got to park your ego. You got to have enough ego, but park quite a bit of it, And one of the best things as you go from being an entrepreneur to being a CEO is to focus on hiring. Hey, it's not easy. I'm not gonna sit here and pretend that it's a simple thing to do. You create this is your baby. But if you really want to scale, again, we're talking about how we got to 100. Honestly speaking, the best thing you can do is to hire really good people, actually better people than you, that can sell, they can market, they can build software and all that stuff, and just let them know and focus on what the mission, vision, and culture is, and then let them operate, get the hell out of the way. It's not just a good thing to do, but in my mind is a must do. This is one of my favorites, honestly, because it's been rough, and I'm not gonna pretend that it was easy, but I don't regret hiring this phenomenal talent. They're the ones that are actually getting this done, and you're just sitting there and watching them operate, and it's phenomenal. But you gotta park your ego. All right, so got 2 minutes to go, and basically this last slide is kind of summarizing all 10. Again, I think that I'd like to highlight, all of them are important, and I could have written another 10 or 20 more easily. But I think that, the ones that my favorite ones are build a great product UX. Make product user experience your competitive advantage, and make it kind of one of the ways that you look at when you look at your growth strategy, think about product UX. Don't think it's just a nice to have. It's a must have. Make your users and your customers your best salespeople. And I think the last one is, product marketing is very important, of course.
I was going to say, our marketing's in there somewhere, Alfonso.
Of course. I'm so thankful, for the job that Sophie has done. Sophie comes from Medallia and from Google. And so back to my point about going from an entrepreneur to a CEO and hired great talent, I never dreamed that I would have a professional like Sophie that has done 8 years at Google Cloud or Google Analytics.
Yeah, a bunch of the ads products, yeah. She spent half time in Silicon Valley, half time here, and it's a pleasure to work with the founder.
And taking Medallia public, which is potentially a path that we're taking as well. So back to number 10, focus, if you want to scale, focus on hiring the best talent let them operate, get out of the way, and enjoy the ride. Thank you very much.
The way you advertise your round, if you're in our space, is you say, we raised it to disrupt ZoomInfo. We had a product and a team that could take us to the next level. There's no platform out there that's brought together the breadth, the depth, and the accuracy of business information the way that we have. None of it is possible without the great employees that we've hired along the way. I think when we went public, it was a major validating moment for everybody. What it cemented for me is if you get a bunch of people together and you get them to believe that they can basically accomplish anything, kind of turns out they can. It's going to be hard. That is the game. There's no way who you are today is who you need to be a year from now. I want to build this company into an iconic software company. That's what we're driving towards.
We did change the title. It was 400 million before, now it is billion, so we've got it.
About $1 billion.
So thanks everybody for streaming in after lunch. Having fun on day 2? Good time? How many of you guys use ZoomInfo now or any of our products or have before? Quick show of hands.
Thank you. I appreciate that. Thank you.
So we're lucky that Henry happens to be here in Barcelona, which is great, and was able to drop by. I think we're especially fortunate to have the CEO of ZoomInfo here today, because as iconic a company it already is, it's very apropos for the time we're in today, right? And we'll talk about it in a minute. If you guys don't know, I think you were the first IPO after COVID hit, right?
Yes. The first.
Yeah, the first weird one where there's just you on Zoom ringing the bell all by your, is that image?
The video of me and my wife pretending to hit a button.
Pretending to hit a button, right? Like peak lockdown, which is crazy in and of itself, right?
Yes.
And then we're gonna talk. Henry was kind enough. We did one of these during peak COVID, during a digital event. Go watch it. It was great. It was 10 mistakes on the way to 400 billion. We thought we're here together. Henry wanted to update it with new learnings about getting to $1 billion in ARR and almost $20 billion market cap. But well, maybe let me click to the next slide. But we'll talk about some of the metrics. But what's not on this is the operating margins of this company.
Yep.
The operating margin, and some of you guys may not even know what an operating margin is yet, but ZoomInfo has been, there are profitable companies, and then there are companies that by their very nature generate massive cash, like we thought software should, and ZoomInfo, the operating margin is like 39%, approaching 40?
39%. 40%.
Yes, so almost for the $1 billion in revenue, ZoomInfo is going to generate almost 400 million of operating income and plus or minus that for free cash flow. It's insane, right?
Yeah.
And this is not self-serve. This is a sales-driven motion. I don't know that there's any company that has a motion like this that has margins like that, is there?
I don't know of a company that has margins like this in software, period.
In software. I think Zoom might be close, right?
Yeah. But we don't have a self-service motion. We go direct to customers. So those of you who raise your hand at some point interacted with the sales rep at ZoomInfo. Now we're also growing the top line. We grew the top line plus 50% last quarter. We did that with 40% operating margins.
Yeah.
In a world where historically nobody cared about operating margins, and when we went public, one of the big conversations we were having with investors is like, why are you profitable? Should you be profitable? And for the next year, there was this constant push about, well, what if we take margins down and increase growth? And should we take margins down more than that and increase growth? And we did actually. Before we went public, it was more like 44, 45% margins, and we've taken that down to just sub 40 to grow the top line. But today, it is a much different world. And that happened, almost overnight. It shifted from take your margins down and grow your top line to make sure you maintain those margins. Those margins are really, really important.
Yeah. So, yeah, and what you were telling me before, just to tease that a little bit, as you're going to IPO, people didn't even understand why you needed to be that profitable. It didn't even make sense to investors, right? In the go-go days, right?
It was actually a negative.
A negative, right?
Yeah,
You must be too conservative, Henry. You're not investing properly in the future, right?
Maybe you don't believe that the TAM is as big as it actually is.
Yeah.
Or you don't believe the company is as good as it is, because if you did, you would take that money out of margins and you put it back into growth.
Yeah. So and I want to just chat on it on a couple more points, and then we'll dig into the 10 mistakes to $1 billion in ARR. But first of all, just for the folks to process it, it's almost a narrative violation versus Twitter, right? And you can either be bootstrapped and grow slowly, and maybe later grow, right? Or you invest everything, right? Because you have to fuel growth. But to be able to do this with the sales-driven motion, people will tell you it's not possible. But this is any great company is an outlier, right? All the public ones are outliers. GitLab's an outlier. ZoomInfo, they're all HashiCorp. But it clearly can be done. Don't have people tell you that it cannot be done. It can be done. And just to break it down, but from a mechanical SaaS mechanics perspective, what lets you do that with the sales-driven motion?
It's the go-to-market efficiency that we drive at the front end drives the ability to do that at scale. So, if you go fill out a form on the ZoomInfo website today, somebody will call you within 90 seconds. The person who's calling you has been algorithmically chosen as the SDR who's most likely to convert your type of company and your level of buyer into an opportunity, a demo for an account executive. When you get assigned an account executive, the SDR gets a ranked list of the account executive that's most likely to convert that opportunity to a closed won business. And then all of our account executives are ranked in 4 different tiers. And based on what tier you're in, you get a higher quality of leads. And if you're in tier 1, you get the best leads. If you're in tier 2 and you outperform your tier 2 peers by 20%, you can move up to tier 1. If you underperform, you move down to tier 3. And the leads are distributed based on the quality of the account executive. So it's a lot of science that goes into the way that we generate the leads, we route the leads, and then we close new business. And that drives a 10x LTV to CAC, a sub 30-day sales cycle. Often deals are closed same day. And these are not like, $2,000 or $3,000 deals. These are $20,000, $30,000, $40,000, $50,000 lands.
And I should know this, but on the marketing side because there's no viral, maybe there's a little bit of viral element to the product, but it ain't much. It ain't much. Is it word of mouth? Because your marketing, you're at that CAC and a sales driven, the marketing cost has to be almost zero. The math doesn't work unless you can't spend a year of just on marketing. It has to be minuscule, right? It's got to be weeks or months. Or 2 months.
So it is short, and it's a lot of word of mouth. It's a lot of SEM, a lot of SEO.
Yeah.
And so that's driving the top of the funnel for us. And that's where we're investing, SEM, SEO.
But that's the bulk, that's the majority, right?
That's the majority.
And did you hack it? Did you have some magical growth hacker you found on AngelList or Craigslist? Or was it just brute force of just doing it year after year?
It is
SEO, SEM magic.
Force and iteration constantly.
Okay, it's interesting. All right, well, we can spend the whole time on that because there's a bit of a counter narrative in that, but pretty cool. But let's go through this. Before we do, for folks, I do think, and then I want to let Henry do most of the rest of the talking. I do think ZoomInfo is a very interesting company because it's one of the ones that more of us have used as a product than know as a company. We're all still newly public, so many. But almost $1 billion in ARR, 25,000 customers. So sorry, the average ACV, I should do it in my head, but about 20 to 30K on average. But going more enterprise. 11% international, which we might not talk about today, but data does take a little bit longer, but now it's the fastest growing segment, right? 80% or something?
Yeah, the international business is growing plus 80% at over $100 million revenue run rate.
And for quite a while bootstrapped, right? And I want to get into this, but when did you de-bootstrap?
So we founded the business, I put $25,000 on my credit card, my co-founder put $25,000 on his credit card. We grew it profitably without any outside funding until 2014. 2014, we're about a $30 million run rate, and we're running kind of 50% margins.
Yeah, so 30 million you de-bootstrapped,
30 million,
right?
Yep.
And what was that, looking back, now that bootstrapping's back in fashion, it went out for a while, was that the right time? the Atlassian founder said they waited way too long, right? I mean, I think maybe they were at 40 million or 100 million. I can't remember. That's a pretty significant difference. But would you have waited longer? Was it the right time? Would you have gone earlier, knowing what you know now?
It's hard to sit here and be about $1 billion run rate company and say like it was wrong.
Well, clearly you weren't wrong.
It was. I think at the time it was a good time to take outside funding.
Take outside venture. And did it accelerate? I should know this, but did it accelerate the business, or did it just create liquidity?
No. You could see like the business did this when we took outside funding.
Got it. All right, I want to chat more about that, but I think we have some of that embedded. I know we're doing a little context switching, but it's one of my favorite companies, but it's maybe the most interesting SaaS company to study today in this market. There's a SaaStr post on it. Research it, learn about it, because you're going to learn more. Most of you will learn more from ZoomInfo than almost any other SaaS company you can read about. So become an expert. But bootstrapping to 30 million, getting to $1 billion in ARR, but number one, not being honest about your talent. I could guess what this means, but this is mistake number one.
Yeah, so this one is basically in the areas of your business where you have metrics that tell you how good people are doing, it's really easy to be vigilant about talent. So in sales, you see 1 or 2 people lagging, you need to spend more time with them or at some point move them out of the business. Everywhere, and for me, I did sales. I carried a bag the first 6 years of ZoomInfo. So I also knew how sales worked, and I could just see like, okay, that person's not gonna work out. Let's bring somebody else in. In the other areas of the business where I wasn't an expert, product development, engineering, marketing, I had inklings that the people in those departments weren't working, but I wasn't nearly as vigilant about talent as I was on the sales side. And so the advice here is what I should have done in those moments was go have informational interviews with great product development heads, great engineering heads, great marketing heads, and try to compare the talent that I was meeting through those interviews to the talent that I had in-house, and then acted faster.
Yeah.
And so you can convince yourself, I don't really understand engineering, and they told me it's hard, so it's probably really hard. And you have a voice in your head that tells you like, why would that be difficult? I don't understand why that's complicated. And you should listen to that voice and go do these informational interviews to validate it, and then move fast on talent in the early stages as fast as you can where you find those.
It's hard to hire a great one if you've never met a great one.
Yep, absolutely.
It's pretty much impossible, right?
Yeah, and I see it in our business today. Somebody comes in and they start hiring people, and I'm like, wait a second, maybe you don't know what great looks like because it doesn't look like that to me. And so yeah, you really want to see what great looks like so you can go try and find it.
Now, we've all made some of those mistakes, and I think, remember that, and I think entrepreneurs I've learned are much better at this recently, which is hunting 30 great VPs of product, VPs of marketing, and interviewing. But if that's not you, if you're not a hunter, go do it.
Yep.
There are more. The good news is today there are more great VPs out there than ever before, right?
Absolutely.
I mean, ZoomInfo's directors will become VPs out. You hope they all stay, but it will spawn 20 or 30 VPs of sales, and some of them will talk to you, right? There's more veterans.
Yes.
So it's not impossible to find 20 or 30 that will talk to you, and
Absolutely.
then find one great one, and then to Henry's point, if then you meet your candidate and something in your back of your mind says they're not great, there's no chance they're great.
Yeah.
It doesn't matter, especially if everyone else likes them.
That voice never gets more quiet.
It
only gets louder.
Now, interesting question. As what I've learned is that often that error repeats itself at the next stage. Then maybe you get to 30 million, like we talked about, and you need a new level of management, and you don't know what that level of management worked. Did you solve it after the first set of management, or did the error repeat itself?
Yeah, no, that's a great question. I think around 200 million of ARR, you started being confident that you knew what great looked like. And then when you were out interviewing, you knew what you were looking for and what wasn't going to work.
At 200 million in ARR, you had it figured out.
Yeah, it took us a while.
All right, well, I think that answers the question. 2, there could be a lot in here. Thinking my CFO, should I emphasize the my or our? Or
our. No, not my, our.
Our accountant. Okay. I can see that going a couple different ways.
Yeah, no, never my.
Rich, can I run the Porsche through the business? Henry, we raised outside capital. I don't know if that's okay any longer.
That was never us. But for this mistake, until we took outside capital, the CFO was somebody who just like did the books, paid the taxes. That was his job. As long as that was happening, we were great.
Yeah.
Ran accounts payable, accounts receivable. And when we took outside funding, they said, look, that's not what a CFO is supposed to do. Your CFO should be your business partner. It should be the person who helps you understand the rhythm of the business, who can create early warning signals in the business to tell you when things are going well, when things are going poorly, can tell you where you should focus, where you should take away your focus and double down. And so I didn't think of a CFO like that at all. I just thought of him as a glorified accountant. When we got a new CFO in, a real CFO, that CFO was able to really articulate the rhythm of the business. He gave dashboards to the department heads so they understood what was going on early. He helped us double down on areas that made sense where we were like shy. He would say, look at this part of the business. Look how well it's going. You're barely focusing on it. Let's double our investment here and we'll continue to reap the rewards. And so really thinking about your CFO as a business partner, not purely an accountant, is a valuable lesson.
And I've actually seen the quality of heads of finance deteriorate the last few years.
Oh, interesting.
I think there may be two root causes. One, startups are growing faster than ever. So however they did in the beginning, they stick with it longer, right? And some of it may just be more competition for limited number of resources. But to tie that together, like, how much can you stretch for the CFO? Is a VP of finance good enough? Like, where's that line? Because not everyone can be the person that took 7 companies public.
Yep.
Like, how much do you stretch for the CFO?
Totally. I think you can stretch here, especially if you get somebody who has like an FP&A type background, a financial planning and analysis background, or somebody who worked in private equity and was like an analyst or a VP and is looking for a change. Those people have tremendous horsepower and they understand the operating side of the business. You can team them up with an accountant who can do all the nuts and bolts. And then that business partner is going to be able to learn the accounting and also just drive the business forward too.
Yeah. And how much, and let's hit the next point, but how much can your CFO really help you model out the future of your business in the next year or two? How much can they own all of it? Are they too input sensitive? Like, how much can they own of
I think a lot of it. All of it, basically. I mean, as long as a good CFO has a really strong relationship with the business. And so they're constantly meeting the product heads, the business unit heads, your sales head, your marketing head. And so they have a feel for the business that's similar to your feel. And so they're not going to get tricked into thinking like, well, marketing's going to quadruple leads next year because they say they're going to. And so they're wise about that.
Yeah, my biggest flag on this hire when it's a stretch is if they produce the model they think you want.
Yeah, totally.
Everyone's happy. Marketing's happy. Sales is everyone's happy. Yeah. And then you just pick at it. All it requires is like flat growth the next 6 months, and then the back half of the year will grow 10x, and then it works, right?
This should be the most sober person in the room.
You would hope, yeah. All right, 3, not appreciating go-to-market. We just talked a lot about SEO and SEM and others, but may that be it as a strategic advantage. What does this mean?
This one's interesting. We made go-to-market really efficient. It's the most efficient go-to-market. It's the most efficient go-to-market org in software, I think. And we didn't appreciate that as a strategic advantage. You start thinking of strategic advantages, you end up oftentimes focused on the product. The reality of the situation is we're building businesses here, and businesses have so much to do with, have a lot more to do with go-to-market and all of the other parts of a business than just product. Product is incredibly important. You have to get it right. But if you myopically focus on product and let the rest of the business not be a strategic advantage for you, it hurts the whole business. I see this in M&A all the time now. We'll go out and do M&A, and what I'll see is 2 companies that are at parity from a product perspective. Both have the same features, same functionality, and one is just running a circle around the other one. And inevitably, it's because the other one just didn't build a great go-to-market engine. Their go-to-market was inefficient, it wasn't very good, it was scattered and broken. And so those are great acquisitions for us because we can look at those and go, okay, that's fantastic, it's a great product, a bad go-to-market engine. We can come in and apply all of our learnings, all of our go-to-market engine to this underperforming company and instantly grow them. This happened with Chorus. We made an acquisition of a conversation intelligence product called Chorus. Chorus.ai. It was growing 100%.
There you've got parity, right? And a good team, right?
Yeah, good team,
but
great
lost
product
the
team.
go-to-market, maybe,
Absolutely lost the go-to-market.
Yeah.
And it was growing 100% year over year. When we acquired it, within 6 months, it was growing 300% year over year. And now it's growing 200% year over year. And so you can view a company that has great parity, great product, and it could be under-delivering because there's no focus on go-to-market. Our jobs as founders and CEOs is to make sure that there's an even distribution of our focus, and not focusing on go-to-market is a big miss.
So I want to come back to this strategic advantage point you make, because I think it's even more important than it looks. But the Chorus one's super interesting because, yes, clearly ZoomInfo has one of the strongest go-to-market team. I mean, the numbers, you can't argue it, right? But Chorus is a different product.
Yeah.
Similar buyers, for sure, but it's not the same. Different questions, different objections, different competitive landscape.
Yep.
Why does it work? Why were you able to so quickly? Because it's not simple. It is different sheets, different everything. Why did it really work for the new product?
Same buyer, and simple product. And so when we do M&A, one of the things we think about is how quickly can I enable all of the sales team to be able to sell this? And our sales team are avid users of conversation intelligence. They understand the value. They know how to talk about it. It's not a technical sale. We don't have to bring an SE in to have a conversation about conversation intelligence. So I can get everybody on the team instantly enabled to take that out to market. And so that's a special one. We bought a company called Ringlead that's way more technical, sells only to the enterprise. And so it's much more complicated to get that type of acceleration. But where you have a product that sells to the same buyer, goes up and down SMB to enterprise, and is easily enabled, that's where you can get a big lift.
I think that the learning there, look, there's many ways to go multi-product. Acquisition isn't the only one.
Yep.
But when it's the same buyer and similar motion, you have the highest chance of success.
Absolutely.
Right? And so many people get tempted to take their technology and move it into a different vertical or a different buyer because on a PowerPoint it looks very logical, right? Why don't we just do this to engineers or to product people? But mostly we see success selling more to buyers that love us, right?
Yes, absolutely.
So this one, just to wrap this one up, but I think this is a really insightful point that I missed a bit as an entrepreneur, which is that if you have a strong go-to-market team, it's a weapon.
Yes, it's an
And sometimes
absolute
we
weapon.
think, oh great, we're efficient, oh great, and we don't recognize how special that is, right? If you have a great go-to-market team, and that probably your competitors don't, and probably you're and you got to triple down. You can't ignore it.
Yep.
If you don't have to worry about sales, invest more there.
Yeah, absolutely. I think the other thing here is if you're efficient at go-to-market, guess what? You've got more dollars to put back into the product and the other parts of the business.
Yeah. Okay, 4. Let's talk about this for all the rest of the time. But not getting, there's so many interesting, this is even bigger than the point looks, not getting your product and engineering team on sales calls.
Yeah.
And everyone please listen in the back to this one, but what's the learning here?
So first, what happens on a sales call is pretty magical. Like if you've built the product and you've engineered the product, getting on that sales call where you have a customer or a prospect and you've got to ask them for money, the most honest feedback ever comes in that moment. And for someone who's building a product, who's designing a product, who's engineering the product, to not be front and center when that's happening is just a huge loss. Like I built product at ZoomInfo at DiscoverOrg, the first company, for the first 6-7 years, and I had a tight connection to the customers because I was also selling. And so I could hear their feedback when I showed them a new feature. I could hear their feedback when they would talk to me about what competitors had that we didn't have. I could hear their feedback when I asked them for money for the product and they said, well, I'm getting it a little bit of this value over here or over there. And your product people will tell you, like a lot of times they'll tell you no. The engineering and product people will be, I'm too busy. Well, fine, if you want me to do it, it's going to push back the roadmap, as long as you're okay with that, Henry.
Yeah, you get that in the beginning. In the beginning. Right? Yeah.
And I think it's just so valuable for a product person to be sitting there and listening to the feedback directly from the customer. I actually think we use conversation intelligence for a big part of this So we record the calls, and then I mandate that our product people listen to a certain number of calls every week. That's a shortcut, but there still is nothing as valuable as the product person being in the seat, sitting there with the salespeople, when you're inevitably going to get punched in the teeth by a prospect.
And does everyone on the product engineering team, do they need to do one a month, or is there still a goal or a KPI?
So for us on Chorus, every week we record all of our sales calls, all of our customer calls, and then they're required in each platform to listen to 5 calls each, and then write up the summary of those calls.
Write it up, but you're writing it up.
We're writing it up.
It happens, right?
Yep. And then I ask them, like, tell me on the product roadmap what we're doing that started from a call listen, where you heard a customer say, hey, this is a problem, and now show me where those things have shown up on the product.
You got to do the write-up. Related to this, there's a topic I'm lately super passionate about. Is I've realized it's getting worse and worse too. How expert does the sales team need to be in the product?
Yeah, that's a great question. The answer is it depends on your stage. So early on in the evolution of our company, when you were creating a category and people hadn't heard of the product and you're the only one in the space and competition was like really fierce and it was kind of more of a duopoly at the time, they have to know a lot about the product. They have to know how to navigate the product. They also have to be usually really bright. We did a really bad job of hiring salespeople. We'd hired 6 and then 1 would be remaining. We'd hire 5, 3 months later 2 would be remaining. We ended up giving essentially a cognitive test in the early days, and it turned out we gave it to our best sales reps. They scored way high on it, and so then we went back and we gave it to everybody who was a prospective salesperson. The ones who scored high came in, they did a really great job. When the company got bigger, that was just a bottleneck to hiring, and it turned out as the company got bigger and more people understood what the product was, the buyers in the market understood things, the product was more featureful, that you didn't really need like the super high IQ person anymore. And that was just hurting our ability to scale the sales team. And so it is, the smaller you are, the newer the category is, the more they really need to understand the product.
And if you just had to, that's a great insight. If you had to guess, when was that switchover in terms of ARR stage?
It probably happened around 100 million.
Okay, well I was going to guess you were going to say 20. So take this away. At 100 million, you can go away from the super smart sales rep that's kind of a product person, that's really passionate, and then you can just do nuts and bolts, that's late. That's late.
Yeah, maybe it's 80 million. But
yeah, but that's pretty late. What I've found is that during the great boom, bars were lowered. Everyone says they raised the bar, but everyone lowered the bar. They lowered the bar in engineering, and we hired sales folks. Not only were they lower, but sometimes we took folks from companies that were too big, that had a huge brand behind them, and then I watched them come in and know nothing about the product. They need an SE and an engineer to sell a fairly straightforward product, and there's it's like a version, you have to come up with some version of Henry's cognitive test, your own version, and have this thespian, this savant, this product, maybe you have to give up a little bit as a closer maybe, right? At the margin, would you give up a little bit?
Yeah, would you give up a little bit?
Would you take someone that in the early days that deeply knew your product?
Yes.
But was a pretty good closer?
Yes.
Would you give up a little bit of the closer?
Absolutely.
Yeah, that's the mistake we make, right? Yeah. So after 100 though, you can do nuts and bolts. Maybe you can get enablement a little bit early, but that's actually a big learning for me to hear you say that. Now this one I don't know exactly what it means. Number 5, maybe you mean the CEO's voice, not realizing your voice is important.
Yeah, so this one we probably do quickly. When we first brought institutional dollars into the business, we had our second board meeting, and on our way down to dinner after the board meeting, I leaned over to one of my board members and I went, well, first of all, this was the first time professional people showed up in our company, right? Like, we were just kind of doing stuff, and then now all these people with Harvard MBAs and Penn undergrads, and they went to Princeton, now they're reading our financials and asking us questions. And my first reaction to that was, oh, they're really smart people, like just tell me what to do and I'll go do it in the business. And I said that to one of our board members. I said, hey, look, you guys just tell me what you want me to do, I'll go do that. And he went, no, that's not how this works. Like, we don't know the day-to-day operating of your company. We don't know the insides and outs of the company. We're gonna give you advice that's kind of general based on things that we've seen. Your obligation is to listen to it and then decide what you're gonna do with it. But it's not for us to tell you something that you then go do. That's not the right structure. And I think like when we talked, Jason, last time, you said you can kind of get into this feeling that they start treating you like their older son. And so they're like, oh, hey buddy, like go do this thing. And they're not actually telling you these things to do, or you should not take it that way. Your voice about what's actually happening in the company and how you can actually execute against that advice is really important. So oftentimes I find myself saying like, that's really good advice. The product team is in no place to be able to execute against that right now. Maybe 6 months from now, maybe a year from now when we do this and do that and line these things up. But right now, great advice, not something I'm gonna go do right away. It just doesn't make sense in our current construct. And so being honest and giving that feedback back to your board instead of feeling like you're just an order taker is really important.
Yeah, I think it took me a while to appreciate it, but I think your board gives you some of your best advice and some of your worst advice.
Absolutely.
And without knowing it, and about equal measure, and it's your job to realize you have to decide, right? And the bad advice isn't wrong, but it's wrong for you, and if you overreact to it, it can be
the timing might be
right.
Wrong. Yep.
Yeah, we used to talk about that. Every startup had a feature that was just for an investor.
Yeah.
There was one. We had a notes tab, and it said like, "Oh, I want to write notes on my document," and we built it 0.00% usage, but it took a day, right? But
totally.
Take too much of that bad advice, especially these days when like SaaS is on fire, but the private markets and VCs aren't. You're going to get crazy advice all over the place, and your voice matters.
Yeah, absolutely.
Right? Okay, 6.
I love this one.
I think almost all of us learn this is almost all that matters later, right? But not knowing how that you have to develop people, probably especially your best people, right?
This is your job.
Yeah.
Like, this is your job. You're not going to go get every superstar out there to come work for your little company. You're a startup. It's just they're not available.
Yeah.
My head of new business sales before he came to ZoomInfo was a caddy. He was a caddy on a golf course. My chief revenue officer was a professional poker player who was a 2.5 GPA in not a great school. Our current chief operating officer was our director of sales operations just 6 years ago. And what you realize is it is your job to develop these people into champions, into world-class leaders. That's our job. Because you're not going to go out and get the best people from Salesforce or Bill.com or wherever. You're going to get people who are not those people, who have an aspiration for the future of being those people, the same way we all do in our startup. And you've got to develop those people along with you. That is the most important thing that you can do. And I think I hired somebody from a big company once. He came in and he started running our SDR team. It was right after an acquisition. And there was one guy on the SDR team who he was having trouble with. And he sent me a message and he was like, "Oh, I hate to tell you this, but this guy's not working out. I don't know what to do." It's like, "Have you told him?" "Oh, no, I haven't really relayed that feedback directly." "Are you working with him to improve him?" "No, I'm not really doing that yet." Well, listen, we build champions at this company, and you're not even trying to build a champion at this company. You're just throwing your arms up. It's like, we have to develop the people around us. When we get somebody in the door, it's our job to make them into champions, and everybody has to go in with that mentality.
Let me ask you 2 follow-up questions. One is, what do you do when they're good but they plateau?
What do you do when they're good and they plateau? That's interesting. You tell them. You go, "Listen, you used to be really great and now you're not so great anymore. And like, let's talk about what's changed that's caused this plateau." Some people burn out and they need to move to a different area in the business. And so we do that often. And then the question really becomes one of opportunity cost. So, and let's just use the sales example because it's easy. But when you think about it in terms of opportunity cost, if I take a lead and I give it to that plateaued person versus I take a lead and I give it to one of my up-and-comers, where am I losing money by keeping that person on the books? And when it starts looking like for every additional lead that I give the plateauer, I'm hurting the overall business because one of my up-and-comers would take that lead and convert it better and focus on it more, then it's easy to make the decision that you need to move on. But I think the number one thing, and people are terrible at this, but the number one thing is you've got to give that feedback. You've got to give them an opportunity to hear where they're falling down and lay out expectations for them. If you haven't done that yet, then you're really not in a place to do anything.
Even to the mediocre, you give feedback?
Even to the mediocre, yeah.
That one I'm still learning. I don't find that it's effective to.
Yeah, that's interesting.
To the mediocre.
I just think we're obligated to give that feedback. Yeah. Whether it lands or not, we are obligated to give it.
All right, one follow-up on this. A different type of plateauing. When you have a director or a VP, and they're great, but they're great up to $1 million a month in bookings or 2 million. They've plateaued in a different way. Like they just don't have the skills. They have the right skills to manage sales at 30, but not 60 or 90.
Yep.
But they can still do the job at 30. Do you bring in more of them? Do you let them go? How do you top them? How do you retain the folks that are great, but they have reached their limit?
You bring in, we often bring in somebody above that person, somebody who's seen that next stage. The key about this is, and we've done it all across our business, the key about this is you have to get somebody who's actually better than that person to go above them. Because if you mess up that hire, then it's a real mess. So if you go when we hired our first CHRO, I went to our existing head of HR who had grown up at the company, and I said, look, if you trust me, I'm gonna get someone that you're gonna learn a lot from over the next few years, who's seen it before, that you're gonna be able to grow with. And I'm not gonna get bamboozled into the next hire. I'm gonna do a good job of getting the next person, and you'll be able to grow and learn from them. And that usually works. If you get the right person, then it really works, because they come in and then right away, that person who you topped went like, okay, I got it.
Yeah.
I didn't know those things. So we top them.
No, that's a good point. I think we think we don't make the mistake, but they have to be clearly better than the person being
clearly
top.
Better than
and the person being top may not, they usually get it at least in a couple weeks.
Yes.
Not always, maybe they sort of get it in the interview process, but they'll get it quickly.
Yeah.
And if you fudge, they just have the experience, but they're a peer or worse, it never really works. They all leave. Yep. All the talent leaves, right?
Absolutely.
All right, 7, not adding great people first before optimization. This isn't how startups work.
Yeah, it's
you
a
just
little
hire the bodies,
yeah.
and then you do the enablement later.
Yeah, so what we did was we optimized everything. And so in all of the manager functions in sales and customer success, they were automated, follow-up emails were automated, everything was very automated. So your span of control was huge. You'd have one manager to 19 people or something like that.
That's unusual.
You'd built so much automation. When we acquired this, we acquired a business called ZoomInfo, then changed our name. When we acquired ZoomInfo, they had a different approach. They hired great managers who inspired and coached and trained their people. They had no optimization, no automation. And they were growing faster. And so one of the learnings is where you have something that's going really well, that's a good opportunity to add more people to that. And it doesn't have to be perfectly optimized. You can get to optimization later, but hire the great people into the org that's working really well, and then think about optimization.
I guess I missed it. It's don't pre-optimize.
Don't pre-optimize.
Yeah, it doesn't
something
get
that's
you
going
anywhere,
really
right?
well, you don't have to pre-optimize.
All right, 8, not understanding questions about your decision.
Oh, yeah.
Questions from whom? From everyone?
Anyone.
Anyone?
So oftentimes I would have, and this happens less often with me today, more often with the people underneath me, but they'll go present something to our CFO, and they'll leave the meeting and go oh, Cameron's not supportive of this. I'll go, well, why? Why is Cameron not supportive? This sounds like something Cameron is totally supportive of. Well, he asked me this, and he asked me that, and he asked me this, and he asked me that. It's okay, that sounds like Cameron trying to understand how you came to this decision, not Cameron telling you he doesn't support the decision. And people can get all wrapped around this. And so it's just really important to understand that when people are questioning you, questioning decisions that you're making, it's not them questioning the decision or you specifically, they're just trying to understand how you got there. And so hearing those questions and going, okay, I understand why they're asking it. They want to know what my decision-making process was, what the inputs were, how I made that decision. That's very different than this is a dumb idea. And they hear oftentimes, this is a dumb idea. They don't hear hey, bring me along.
Is there any leadership trick you have to get the right amount of questions? None isn't good. And too many is overwhelming, right?
I don't have a good hack.
No trick for that one?
No, yeah.
But people ask you questions.
People ask me questions all the time.
Yeah.
And like, I understand today, like they haven't, I have more information about the company, about our investors, about our customers, about marketing, about product than anybody else on the team. I just have more information coming in than anybody. Yeah. And so when I make a decision, it is my obligation to bring people along and share the inputs to that decision so that they all can get behind it.
Yeah, I think that's my big takeaway. Make sure you get enough questions because they are the vehicle to bring people along, right? They have a value far beyond themselves. Yes. They bring people along, and as CEOs, sometimes we make too many decisions without bringing people along because they're clearly the right decision. Yeah. And it's going to backfire on you 20% of the time, right? Yeah. You got to just like grooming your team or growing your team. You got to put in the time on the question.
It's way easier to get alignment when you're answering these questions.
I actually think in the earliest days, this is the most valuable part of an e-staff meeting or a staff meeting is to get. It doesn't matter. Everyone presents, but the cross questions. It's a format that forces people once a week to ask these questions.
Yeah,
right?
And then for people to articulate how they got there.
Yeah. Okay, 9. Okay, this should be pretty tactical.
Yeah, this
not
is really
having the right accounts. We probably all have the wrong account structure.
Yeah,
what do we
you do.
What do we learn?
At any moment in time, you have the wrong account structure. I think the key thing here is, number one, segment your customers. Don't treat them all the same. That's like basic. I'm sure like one of Jason's very first posts said that.
But people wait these days.
Yeah, that's interesting.
They wait longer than you might think to segment their
customers. A certain amount of customers before segmentation makes sense. But once you get there, segmentation makes sense, no question about it. It might be by industry, it might be by size, whatever it is, you should be thinking about segmenting your customer base. Now, the learning here is you're never really done. You're always resegmenting. I'll give you an example. We segmented by size and growth potential. And so if you were an enterprise company with high growth potential, we segmented you together. You had an account manager who managed a bunch of enterprise accounts. Well, it turned out in a group of 15 enterprise accounts, you often had 12 that were spending $500,000 to $1 million or more with you. And then you had 3 that were spending $50,000 a year. High potential to grow, $50,000 customers. Guess who was getting no attention by the account manager? All of those sub 50K large enterprise accounts that got landed small. And so we went, okay, that's bad, and you saw it all the way across the business. So we pulled those 50,000 and below accounts from the enterprise, and we created a different segmentation just for those, and immediately you saw results.
What'd you name them out of just from a learning? What'd you call them if they were an enterprise?
I think we called them sub 50K enterprise.
But this happens to all of us, right? That once you segment, the small guys in each segment get ignored.
Yes,
by
absolutely.
Sales and customer success.
Yes.
So you pull them out, maybe even doubling your segments, and you put a team, and your job is to grow 50K to 100K or whatever the number is. Yeah.
Yep.
Cool. Well, any other learning on the account structure?
No, that's it. It's always changing.
Yeah. And when did you? I literally got an email. Well, this is maybe 6 months ago, but from a CEO. A company where the CEO is an incredible sales leader, like with decades of experience, saying at over 100 million, we're just segmenting our customer base now.
Yeah, interesting.
And that's not, I mean, I don't know that many in 100, but I talk to more and more founders, and sometimes they just want to share everything, or they don't want to break what's working, but I think we're later to segmenting. Do you remember when you started doing it diligently?
Diligently, yeah, probably around, actually, it's a good question. Probably around 80 million.
80?
Probably waited long, yeah.
So now you're thinking all these are early days at $1 billion in revenue.
Yeah.
I think 8 is late. Because I think by the time you have 100 customers, you can segment them, can't you? Even 100. You'll see patterns in 100.
Yes.
And if you don't start segmenting
that
around
was
those 100,
way late, by the way.
Yeah.
Way too late.
Yeah, late, right?
Yeah.
I mean, you did okay, but
yeah,
late,
way too late.
All right, the last one on this one. Not practicing difficult conversations. I might be getting worse at this one. Okay, what does this one mean?
Yeah, so this one is, look, all of us have to have difficult conversations with our peers, with our staff. They're never very fun. But I think what my team started thinking was, the people at ZoomInfo started thinking, once you're the CEO, these are just super easy. You just like roll out in the morning and you go have a bunch of difficult conversations with your team. That is not the case. I practice these. So before I have most of my difficult conversations, I have said those words out loud. I have practiced and thought through how my direct report is going to react to it. I'm thinking about like what I would say based on that reaction, and I'm actually practicing how I give the feedback. And it's really important, like the times where I just go into a conversation, no practice, and try to give feedback versus the times where I actually practice it out loud and give the feedback, the result is, you know, on completely different extremes.
Do you literally do the mirror thing that some people do?
I don't stand in front of a mirror.
Some great people do that.
Yeah,
right?
yeah.
Sometimes you'll walk into the restroom and you'll see it even once in a while. Yeah.
I just say it out loud somewhere. Yeah. I say it out loud to myself, and then I can hear how sometimes it sounds stupid, right? Like my first inclination was very bad. And so it gives me an opportunity to iterate against it, and then those conversations become much easier. These are very important to practice.
And how often do you do this per month or per week?
I probably do this per week 2 or 3 times.
Because I think this is a good learning for me, for all of us. I think as we scale, maybe we do less of this intuitively. Because we know so much, we think we can just shoot from the hip on these difficult conversations.
Yeah, you can.
But if at $1 billion in ARR, it's gotten more and more valuable, I'm gonna take that away myself. Well, let me just see. I think we're out of time, or might have gone over. Oh, we are out of time.
Okay.
Otherwise, I take some questions. But Henry, thank you so much for this.
Jason.
This was great.
Thank you.
And in all seriousness, we'll break. But if there's one, we've had so many great companies here today, and we'll have. But if you want to learn from one in this climate, follow ZoomInfo. Go look at its analyst reports. Read the SaaStr report on it. But follow this one because you can do it. You can have it all. ZoomInfo's, not that it's never easy. As we know, but you can't have it all. All right. Thank you, Henry.
Jason. Thank you. Thank you.
It's not showing up yet. But hi, welcome. Thank you so much for joining us. And today we'll be speaking about navigating the rocky road from founder-led sales to hiring the first dozen sales professionals. And I'm Veronika, co-founder and CEO of Demodesk. Demodesk, to everyone who doesn't know what we are doing, just so you have context, is a sales meeting platform that mainly does three things. So we assist reps in the call with playbooks, battle cards, in order to increase close rates. We automate workflows related to the meeting, so scheduling, preparation, documentation, and also help sales teams get insights into what's actually happening in calls to close the loop. I started Demodesk 4 years ago, and I've been working together with Lauren for the past 1.5 years.
Yeah, and great to be here. Thanks for joining us. I'm Lauren Wright. As Veronika said, I've been at Demodesk for about 18 months and joined Demodesk really because I had spent actually the past 9 years before Demodesk at Glassdoor, starting there at kind of the early infancy of our monetization and in the US, and then moved to Europe a few years in to launch the European business, and went through all sorts of rocky parts of that journey. And when I met Veronika and the concept of Demodesk, I was like, wow, this was the tool I've been looking for all of those years. So just help scale up the business and build repeatable process. So I'm really happy to talk about that rocky road and share a little bit of that story today.
Yeah, so for every startup, especially in the SaaS world, there are typically 3 stages of growth. So the first one, obviously product market fit, from 0 to 1 million ARR. So 1 million ARR is the kind of typical benchmark for figuring out whether you have product market fit or not. I mean, there are also a couple of other signs, but this is like the number one thing in B2B SaaS especially. Then the second stage, predictable, building a predictable sales process, hiring a sales team, typically until 10 million ARR. And then beyond that, it's more focused, of course, on building a scalable, repeatable sales org, going into multiple countries, launching multiple products, launching basically new things beyond the things that you just did in the beginning. So we are at the moment at this baby blue stage in the middle, and we are basically past the product market fit stage early last year and are now growing towards 10 million ARR. And I'll be mostly speaking about the green stage for product market fit, whereas Lauren will be focusing on the baby blue, the second phase, predictable. So the first question when you are a startup that is just getting off the ground is, how do you actually get your first 10 customers? I mean, especially for us, we B2B SaaS, we need to get our first 10 companies that use our product and pay for it. And how we actually did that, how almost everyone else also did it, is really reaching out to our personal network in the beginning. So friends and family, trying to basically leverage anyone we knew who also had a tech company, had a SaaS company, knew someone who had a SaaS company, being really, really annoying, asking for any introduction that we could find. And by doing that, we were actually able to get to the first 10 users. So I'm saying users because back then they were not really paying. So it was in 2018. We were first launching the product and really trying to get this in the hands of companies, in the hands of users, trying to make them use it and not stop using it, which as a first step was also quite of a success for us, right? So that's like a major step, people using your product and like not stopping to use it. And then by the end of 2018, we also said the product is now ripe enough. We also need to make money with it. So in order to build a business, of course, you need to charge money for the use of your product. So what we did is going to the users that we had and said, hey, we need to charge you money for it. You can continue using it, but you need to pay. And luckily, most of them said, yeah, it's fine, we pay. And then we had 10 plus customers, which for us was really the first big milestone. When we had that end of 2018, we applied for Y Combinator. So Y Combinator is a startup accelerator in the US, located in Mountain View. And you have to go to Mountain View, or at least back then that was the case. Now it was all remote. But we had to move there in a house, living together 24 hours for 3 months. And that was actually quite a challenge, because starting a business with another co-founder, just the two of us with a couple of students, doesn't mean that you need to acquire customers only in the first place, but you also want to make sure they don't go away. You want to make sure they are happy, you need to support them. Basically, it was just us who needed to do all of this.
So when we moved to San Francisco, it was quite challenging because we had to stay awake during the night, basically, because all our customer base was in Europe. So how that looked like was I was going to bed, leaving my phone on, and then every second night or so it really happened that a customer called, has a question, has an issue, needed us to fix anything in the product because of course it was breaking all the time. And then I was really trying as hard as possible to not let the other party realize that I was asleep a second before. And if there was a real issue, it was going out of my room, knocking on my co-founder's door. He also woke up, took his laptop onto his bed and fixed the problem and went to sleep. So that's actually really how the first phase looked like for us. And once we were beyond 10 customers, the next thing that we needed to understand, and also that of course every startup needs to understand, right, is how to acquire users and customers that you don't know yet, that did not hear about you before, you don't have a connection to them, they've never heard about you or your brand, which also is a new challenge. So growing from 10 to 50 customers was for us the goal at that point in time. And we focused on that for the first half of 2019, and we did a lot of scrappy things. We really tried to do a lot of things that don't scale just to get to this 50 customer benchmark. So just also to name a few examples, we were scraping LinkedIn. So I don't know if I should tell it, but I just do it. So we basically set up a fake profile on LinkedIn. It was a fake SDR, a female SDR, who was running on a bot, and that bot reached out to all our potential customers. So we built a bot that scrapes LinkedIn for potentially interesting profiles that fit our ICP persona that we're looking for, and then ran a bot with that person, she's called Elena, and reached out to these people automatically and then just scheduled meetings. And that brought us to the first 25 customers. We also hacked Product Hunt. So Product Hunt is a platform where you can launch a new product, and the number one goal really is to get number one product of the day, and that means you need to get a lot of upvotes. And in order to get there, you need to have, of course, a lot of people clicking that upvote button. So what we also did is we reached out to all potential Product Hunt launches, so companies who had a successful Product Hunt launch, asked them what they did well, did the same, and also again built a bot that reaches out to all of our network on LinkedIn and Facebook, asked them to sign up on Product Hunt 2 weeks before the launch, and then when we launched, also asked them again to upvote. So basically the point I wanted to make here is really do things that don't scale, just do whatever it takes to get you to the number of customers that you need to have in order to be sure that now it makes sense to hire a sales team and hire your 1 or 2 first sales reps, which also again was the next challenge. So in 2019, we were looking for someone to join our sales team. And I was also just recently talking to one of my portfolio companies who was also now hiring the first sales rep. And he was telling me, yeah, I think we should hire someone from Amazon or someone from Outreach, someone from a big sales org, and someone who really has a lot of experience in selling. And I said, well, I don't think so. I think you need someone who is really able to find their own leads, is really able to hustle, is hungry, can live in an environment where there's nothing there yet, where there's no established process, who is really a builder, who wants to build things, who wants to prove things. And that's also what we did. So we found someone for our next one and then really focused on results. We accepted that process was super, super inefficient back then. So definitely a lot of the tasks that we did back then, we shouldn't do anymore today. But whatever it was that brought us to the results, basically was right for us back then. This chart, I did not make this framework, but I love it. So my sales advisor gave it to me. And it's also a commonly used framework. It basically explains that during these 3 phases of growth, which is product market fit, go-to-market fit, and then growth and mode, which is the latest stage, that really all of these phases have the different challenges and the different things that are important in these different phases. So especially in the first one, right, it's really important to make sure that the customers that you acquired, they are happy, they love using your product, they don't stop using your product, and they're successful with it. Everything else belongs to the second phase. Only in the second phase, it really makes sense also to think about unit economics, think about sales quotas, think about basically customer acquisition cost, and anything else that helps you really build something that's repeatable and scalable.
Great. So your founder has, at this point, built a nice stable of customers. And if you're a head of sales, you come in as a VP of sales, whatever you're taught, you really need to assess like what that customer base looks like. Because as Veronika said, she did whatever it took. She was block and tackling and got a large subset of customers, which is amazing, and actually outside of her friends and family. So complete strangers validated the fact that that Demodesk solves a large problem. So check that, great. But as you look into that customer base, you might find an interesting set of animals. Maybe there's some deviation between the problem that you set out to solve and actually what you're solving for the customers. And maybe they're telling you to do more integrations and customize this and customize that. So you really have to step back and say, okay, where can I pattern match within my customer base and find out where we have a really, really good product market fit, and then lean into that. So the first thing we did was segment our customer base and create a sort of leading indicator of success. Who were the customers that were going to renew with us and were growing with us? And we created a customer health score around a number of different parameters. And then as we were looking to acquire new customers, we even took it a step deeper, and we created sort of a proprietary system called PRIT, which basically stood for what is their revenue motion, what integrations do they have, and how is that going to tell us who our next customers should be. And the reality is you go and pitch to VCs and you tell them, this is a huge blue ocean. We have so much TAM. This is a $100 billion problem. But the reality is you need to really come in and say, okay, who are the customers that I can help today? And it definitely is different from that big vision. And it's easy to get very, very distracted, especially if you have inbound leads coming out. You have those hungry reps that you hired initially who are looking at, this is a nice shiny logo, I'd like to bring it in. And you start to get really disorganized very, very quickly. So we use that proprietary scoring to actually identify the customers that were our sort of perfect customers. And then we went and kind of brick by brick created account lists that were lookalike accounts to those customers. So that really helped us narrow in who are the next 100, 200 customers that we need to be going after today, and start to really create a very strong and stable customer base. So that customer base is built around the central problem that you're solving, and then understanding what it takes to get them in the door. Like map out the customer journey step by step. What does it take for that customer to actually buy your product? And you may need to define your ICP again. It may be different than what you thought it initially was. And by the way, if you're further along in the journey than the rocky road from founder to sales-led, and you actually have created a scalable process, you're on the road to repeatable process, this problem kind of comes out again as you're trying to go maybe international. I certainly had this happen when I was launching a team in Europe and had a repeatable process in the US, but suddenly our ICP was slightly different, and I had to redefine that as we went along. So there are certain, I would say, aha moments along the journey, and Veronika already identified, one of them was when she said, all right, I think it's time to hire that first sales rep. I actually have customers that have bought from me that are not my friends and family, which is like a great thing. And I say aha moments, but make sure that this isn't like an emotional gut feel thing. It needs to be validated by real quantitative, ideally, moments that happen, and you have to create sort of scalable gates for yourself so that you don't get ahead of yourself. So really trying to discipline yourself of like, do we really have product market fit? Do we really have a predictable revenue process? And actually, David Kellogg was here yesterday morning and went through sort of a mini masterclass on how to figure out repeatable process. If you didn't see it, I recommend you watch that recording, so I won't go into tons of detail, but on this slide. But what is super important is that as you start to hire that first sales rep or that second sales rep, that they get to productivity or they're on their way to productivity, and then you layer in the next reps. You don't just hit the gas and then hire 5 more reps, because it's very, very difficult just because one thing happened to get the next thing to happen as well. And then once you have that first squad of people, really seeing that they can actually hit quota together. So I think the magic number is 80% of the team get to 80% to quota or higher, which is hard to do. There are many, many teams that are fully scaled and not hitting 50% to quota. So it's very hard to do that magic number, and if you hit that magic number, then potentially it's time to hit the gas. The other thing to look at is thinking about, okay, you may have predictable process. You may have figured out like what it takes either by leads or by going outbound to get a customer through the funnel, and you can rinse and repeat that, but it may be predictably inefficient, and that's what you don't want. So you may be running a business where your unit revenue economics just don't make sense. And then you need to really figure out, okay, what are the levers to growth that'll get me there? And maybe you have a expensive CAC initially, but you have to figure out a plan to reel that in. And not just say, I'm going to reel it in, but actually map out a plan and progressively reel that in, and then layer in your reps over time. Along the way, you also ideally have it all figured out in that you are supporting those reps. You initially have your things have changed, or your Raskin matrix messaging very clear for your initial customers. You also have the right pricing and tools, initial tool stack to support your customers. When you get into repeatable process, you have the playbooks to actually support reps. So you can't just bring in reps and have them drink from the fire hose. They have to be able to, in fact, I learned that the hard way. I had hired a rep, initially just one rep to bring in, and someone who was very experienced, and I figured he'd figure it out. Well, he didn't, and he was very lost, and luckily he had the sort of characteristics that Veronika described and was able to kind of manage through that situation. But you really want to hire reps, give them the sense of autonomy that they need to figure things out, but also the guardrails, and that comes with having playbooks. You also need to have solid unit economics figured out. But the reality is there's pressure to scale quickly. There's a plan that you probably subscribe to scale quickly, and you end up hiring too many people too fast without a real plan to productivity. You also may see some aha moments along the way and decide that it's time to scale up when there's probably some piece of the puzzle missing, whether it's on the acquisition side, or I've heard stories, I luckily didn't go through this, but heard stories of acquisition side being very, very strong, but things were going out the other end very, very quickly. So make sure that your net revenue retention is there as well. No playbooks, lack of adherence. 1 in 4 reps fail. That's the average. So your burn rate can get high either very, very quickly or slowly just increase over time. And absolutely nothing, none of this works, even if you have the perfect playbooks and you have the perfect tool stack, none of this works if you can't figure out hiring. In fact, if you screw up a lot of other things, which you inevitably will do, we all do, if you don't hire the right people who are utility players and missionaries, the people who, yes, care about compensation and care about the things that salespeople care about, but if you don't hire the right people who are really in it to build something with you, who are doers, then you're going to have people leaving the organization because they don't have it in their heart. They don't care. So you have to really figure out hiring. And that is the piece of the puzzle, how to survive. There are plenty of headwinds when it comes to hiring. You don't have an employer brand. The market hopefully is getting better, but it's been very difficult. And maybe amazing talent on paper, like Veronika's example, having a glossy logo is not necessarily the right person for your organization at the right, when you're at the early stage. So really finding that entrepreneurial person. And usually that comes through networks and being able to tap into people who will subscribe to the culture that you're building. So I'll pass it over to Veronika. I mean, for me, I think hiring underpins all of this, but I'll pass it over to you of your key takeaways since you've been on the journey from the start.
Yeah, so just to summarize what we've basically been telling you for the past 21 minutes, so we're good on time, is like 4 key takeaways in order to really build a sales organization from scratch. So, I mean, we started from nothing. Also, in my case, I'm a first-time founder, so in the beginning for me was particularly hard. And number one is really there's no other way than just hustling in the beginning. You need to hustle, you need to figure things out yourself. You can't rely on someone else to solve things for you, to figure out who to acquire, how to acquire customers, and also how to retain them. It's really something that you as a founder, founding team need to figure out. And also then the first team members that you hire also need to be hustlers as well. Other than that, like it's super, super tough to really build a business from scratch. And the talent who might be a right fit for the first stage, so for the very early stage of your business, definitely might not be the same fit for later stage. So we also had a lot of cases where we hired people in the very early days who were amazing fit, but once we grew to a certain revenue threshold, they were just not a fit for us anymore. So either they moved into different positions or we just parted ways because it just didn't fit for the stage where we are. And that's also sometimes not easy and also sometimes painful to learn for a founder, especially because you always see your startup as a family, but at some point in time it needs to grow into a business. And yeah, nailing your ICP and buyer journey is definitely number 3. So we did some mistakes as well in the early days. So we tried to just acquire every customer that wanted to pay for a product and didn't necessarily find out enough about them to really understand, is our product a fit for them? We just said, hey, you want a product, you want to pay for it, great, please take it, awesome, we have a new customer. And in the early days, that's fine, but later you just pay for it because they churn and it messes up with your numbers. So latest by the point where you need to focus on unit economics, you really need to stop doing it. And we definitely also had a few cases where this happened. And yeah, number 4 is definitely, unit economics. Before you really haven't had 2 reps who are hitting quota consistently, up to 80%, before you haven't really gotten to a point where you know what the quota actually needs to be, how high does the quota needs to be, it doesn't really make sense to scale excessively because it just makes the problem bigger. It just helps you, doesn't help you really figure out what are your unit economics that you need to optimize for. It just creates a lot of clutter and focuses you away from the actual things that you should need to figure out at this stage. I don't know if I had forgotten anything, if you want to add anything here.
Yeah, the other thing around hiring is potentially that you also have to create conditions for people to be successful. So create conditions for them to develop and grow within your organization. So you can hire all the right people, but they will leave if you have not given them autonomy to grow and develop, and that's why they joined your organization. And it's really, really hard because everything matters, every day matters, especially at the beginning, every second matters. So it's easy to want to try to really micromanage people or get on, but create systems for them to live within, but give them autonomy to grow. And I think that culture, they will help grow the culture. They will help build the company. They are the people on the front lines that are going to tell you when things aren't working, when they are, instead of those, more seasoned players that maybe work at an established company who really just want to kind of plug in, get the playbook, and go. The people that you hire are so important on the sales reps and your SDRs to tell you what's happening in the market. They are talking to the largest volume of customers, and you really have to be able to listen to them and also empower them to be their best. So I think, yes, hire the right people, but you are also very much responsible for creating conditions for them to excel and grow. And if you do that right, it'll be an amazing, amazing journey that will, change lives and be memorable for everybody. So it's a very important piece of the puzzle.
So we're actually 4 minutes earlier than expected, so we would have time for some questions if there are any. I don't know if this is part of the... There's one question, yeah. Did you have one question? No. Sorry, I thought you were raising your hand. Okay.
Oh, sorry, it's not on. It's on? Okay. Thanks, girls. I just hired my first VP of sales. I'm a founder, so we had founder-based sales up till now, so this is the perfect lecture. So my question is, what is the biggest shift or the biggest change that Lauren brought to the company?
The biggest change you ever came across in the company?
No, what is the biggest shift that you brought now when you came into the role of VP? If you can point out what one thing that really changed compared to when Veronika was doing it, what changed the most? What's your biggest impact?
It's hard to understand.
I know. I think there's background noise, so it's hard to understand. But I think it's what's the biggest shift or what's the biggest change impact that we've seen in this journey so far. Yeah. I mean, for me, I've been at the company 18 months, and I say only because it feels like, of course, startup years are like dinosaur year, your dog years, sorry. They feels like a lot longer than that. I mean, I'd say that the biggest shift, notwithstanding, market conditions obviously completely shifting, which is we're all going through. But I think for me personally, in my own career, I went from a company where I was there for 9 years, and I had gone through various stages of growth. And so for me, it was a shift back from I had already had repeatable process, and I was kind of a startup within a startup in Europe. And then I went to join Demodesk and just really building again from the start, which is like my DNA. So I love it. I'm a problem solver. I like to roll up my sleeves and get my hands dirty. But for me, that was, I would say, the biggest change. And it really had to shift my mindset back to the building phase and not the scale-up phase. And that, and really, I think the ICP and defining your ICP is very, very, very difficult, especially if you're a category leader. If you're trying to create this new category, plant it in the ground. Yes, there's a lot of overlap in sales tech, but we don't have any very, very direct competitors that are at least leading the market. And so that is hard to do because you really have to lean into that mind shift of things have changed, this is the way forward, and really convince people in sort of a challenger way to do that. And that makes finding your ICP harder when you don't have established competitors in the market. Yours might be very different.
I think was a perfect answer. We almost the time's almost over, but I mean you can find us on LinkedIn. You can also email us. It's Lauren or Veronika at demodesk.com, or also grab us at the conference if you have any questions. So happy to talk, and thank you so much.
Thanks, everyone.
Hey, good afternoon, everyone. It's great to be here. It's great to be in Barcelona. So I think we're the last panel of the day, so everyone's very, very welcome. So the topic of our panel today is 6 things nobody tells you when you're raising a seed round. So on the panel, we have 3 great seed investors, and they're going to dive right. We're going to dive right into it. So we have Zoe from Frontline, Carmen from Cocoa, and Rouven from Cavalry. So I'm going to kind of get things started. So kind of when we were talking about this earlier, just going to grab my so the first question we kind of wanted to kind of address was, why seed funding? I think, when we talked before the panel, we kind of came to the conclusion that expectations were very important. So my first question is to Rouven, and I suppose it's what are you looking for? What are your expectations of a company and of a founder when they come to you?
Yeah, I think it's very important to understand that not every founder team should take actually seed funding, because there are different models, and there's also different expectations from investors, for example, and for founders, sometimes it can be a great choice to bootstrap for quite a while, or actually for as long as the company is existing. And there are numerous examples of even billion-dollar companies being founded like that, right? Especially if you're in somewhat like in a profitable niche without much competition, or for example, also if you have a very unique technology that does not need funding, but then comes the point, and I think typically where founding teams say, look, I want to take on funding, and that starts with the angel or the pre-seed round. It's actually the same term of the same thing, where you go out, you talk to friends, you talk to family, you get feedback from the market, and then somewhat organically you're offered the first check. So that means you get somebody else into your company as shareholder, and if you get that, then ideally you get that person or that fund who will add value to you, because you will lose somewhat of your independence. That person wants to have rights, maybe a board seat. So really make sure that there's a value add for this equity that you're giving away next to the cash. And the cash itself is then for you extremely useful if you know certain repeatable metrics already in your playbook. You know how to do sales repeatably, how to invest more into your technology, how to build out the core team. Can be very early, but if you know that you need those funds in order to outbeat competition, then it's definitely for you the right means. And especially nowadays, you want to take on funding very often because just, the disruption cycles are very quick. You don't have 20 years often to build a big company, maybe 5, maybe 10 at most. So this is why you would really need seed funding and then most likely more funding.
Great, and just to build on that, Zoe, so when you try and create alignment with the founder, what are you looking to achieve?
Yeah, it's a really good point. So I think just to build on what Rouven has just said, for me, one of the first things out of the traps is, do you really understand what I'm thinking when I sit opposite you as you request kind of seed funding from a fund? And by that I mean, are you up for what this journey, from my mind, is going to look like, which means building something super high growth at a pace which is actually quite relentless, has lots of ups and downs, has a lot of different stakeholders to manage, but where you understand that every, time is precious because you need to kind of get ahead of your competition. So it's almost a mentality check-in that the type of journey you're up for isn't something which is perhaps 2 or 3 years, it's much longer, it's to build something of truly huge impact. And a fund like mine is looking for, we're underwriting to kind of at least 10 times the money that we're putting in. So I think it's kind of getting above it all and saying, if I got an offer for £10 million for this company, 10 million euros for this company in a few years, would I take it? It's a great answer if the answer is yes, but it just means that, sitting opposite a venture capital fund might not be the answer for you, because that mentality of, building a fast-paced team, compounding over time, is one that is, I guess, quite unique, and that's what I guess I am looking for in those founding teams.
Yeah.
And I think what Zoe just said is actually very important. Like, you don't have to raise from a VC necessarily, and this sounds unsexy because according to the news, it feels like if you want to be successful, you need to raise from a VC. But it is almost also a lifestyle choice, and there's no right or wrong, right? It depends what you want to do with your life, and that, you're the only one to know. But you need to think about VC as like a highway. If you can take it or not take it, and by the way, you can get very far without taking the highway, but if you take it, you cannot get out of it, so to say, and you need to drive very, very fast, and there's a series of expectations that come with that. So it is that pre-raising a seed, you really need to think about what do you want out of this business, what do you want out of your life, and then choose one or the other, right? And again, you can get super far, make tons of money, be very successful without a VC. It's just a different path or a different road to get there. So that's something to really think about.
And Zoe, we talked a little bit earlier about other forms of kind of financing and other options. I mean, bootstrapping, raising other types of finance. Maybe you could kind of take us through your thoughts on that.
Yeah, of course. And to Carmen's very good point, it's a choice. You've got many, many choices. And I think the way to think of your business is equity capital has obviously been super, super cheap in the last couple of years, but it is by no means the only source of capital out there. And you can start right at the very bottom with, am I building something which has got quite a high level of research and development? Am I hiring PhD students? Does the country that I'm building in offer grants? That's completely not free money, but it's non-dilutive capital. So there's grants out there which absolutely be looked at. They might pay some people's salary, they might cover your R&D costs, there might be some tax credits in there. Then of course there are loads of different forms of debt. Now, debt works obviously so much better than equity in a number of ways. So when you are taking equity dollars, and I say this as the VC, I would hate to think that you were taking our money to hire out a plant or buy some machinery. It's actually typically, reinvesting in headcount and investing in building that product. Once the product is built and you're selling it and you have a revenue stream, which may be a SaaS business model, it may well be e-commerce. Of course, there are tons of players in the market and startup scale-ups who are specifically there to finance some of those revenue streams, just in the same way that there are working capital facilities. So if it's just a timing point about your creditors and debtors, there are other places where you can get much cheaper capital and you're not having to give up parts of your business. I'm putting myself out of a job, but that is all to say that, alongside equity sits other things. And just to name some that are in Europe, there are obviously Clearbank, Pipe, CapChase, Wayflyer. There's lots of options if you do have this kind of repeatable revenue stream and you have bootstrapped to that stage. So I think just to like round it all off, you should sit there, you should say, what is my mentality? What am I up for building? Do I want this type of lifestyle and all that comes with that, which is both upside and potential some like, ties. And if I do want that, what's the best way to build that? And that might well be with equity, and it might well be with forms of debt and also grants.
Really good. So yeah, we're just going to move on. So the next kind of point is when to raise a seed round. So you've decided to raise venture funding. I suppose the question then is, when do you do it? So Rouven, when do you think is the optimal time to raise a seed round?
Well, I think once you've decided that you want to have venture funding, then I think it's always a good time to raise money when you actually can raise money. It sounds somewhat easy and obvious, but when raising money is not like as if you set up for like a rendezvous with a VC and then say at the end you make it. Often it just happens in a way that you start a conversation, you go out in the market, and you learn that VCs are interested in your business. And what you can do at the same time, and in this natural process, you can actually stage, and you shall stage at a certain point, which is more towards the seed or Series A and post rounds. Once you know what your VCs expect, what kind of metrics they want to see. Typically in a seed round, it's little bit, you have to have early signs of product market fit. You have some customers, if we talk B2B, not many, rather have your customers engaged. You have to have a big market, you have to have a great founding team. Anything where a VC actually says, look, when I invest, I can pay back my fund, ultimately X amount of time. So you also have to understand how big is the fund that's coming in. They want a certain ownership. But ultimately, it's about that for a VC. And whenever the momentum is right, whenever you get offers, I would say go down that route.
And I suppose the second question is, obviously, in the current environment, Carmen, is now a good time to raise a seed round?
It's a very good question. I would say also, when to raise, you can judge. But when you're raising, you're raising. That is the important thing as well. It's like when you decide to go. And we can discuss later how the process looks like. But so the market right now, we've discussed this a lot earlier. Feel free to jump in. It's a bit difficult to tell at seed because growth for sure has been impacted negatively. Reality is, we can say at seed things are still happening and we're still investing into companies, and you see still great deals. Probably, and in full transparency, there is less velocity in the deals. They're slower because people are taking more time to think whether to invest and to build a conviction, and they're being more picky. And the bar is higher from an investor perspective, just because there is such uncertainty in the market that their incentive to invest is toned down a little bit versus what it was 6 to 12 months before, right? But again, deals are getting done all over the place and still at healthy valuation. So what I would say is if you are ready, to the earlier point, to go out and raise, because the good founding teams and the good opportunities are still getting funded. Now be mindful that it might take a bit longer. Be mindful that dilution levels are adjusting. So the kind of below 15% dilution that we were seeing a few months ago are now very, very rare. The sizes of seed rounds are also adjusting. So 5 million at 25 are now sort of unicorns, and you probably need to be a second-time founder that exited his or her company. So just adjust a little bit the expectations and think about how much money do I need to get 24 months of runway, and what are the terms to build to get the best partner. And I think if you have something that is valuable, you're like a strong team, you're going after a great market opportunity, and your expectations are reasonable to create win-win situations with the investors, deals are still happening.
Great. Does anyone else want to add to that in terms of how you're seeing things at the moment, Zoe?
Listen, seed is a wonderful place to be because seed will always exist. Seed has to exist. We absolutely want to invest in the brightest and most exciting and crazy people of the future who are building the future. But I think all of Carmen's points are valid, which is just the one thing that I would take away is that the market absolutely exists, deals are absolutely happening, but you cannot put your head in the sand and think that 2021 is carrying on. The growth markets, the follow-on rounds, they have almost stopped investing. Seed deals are still being done. They're just being done with a bit more reflection time and the right pace, I would say. So for me, timing is all about what are you de-risking between now and the next stage, but thinking that that will take 2 years. And there's no founder who I have met who has said they wish they took a little bit less and they did things way quicker than they expected. So perhaps as much buffer as you can get on that 24 months runway, and you tell the story, whether it's pre-product or pre-revenue, about how you get to that next important milestone and what value you are then compounding onto your business and why the next investor will be excited because you will have taken this level of risk off the table. And if you can tie that together in a great narrative, then of course you will be getting investors excited at both the pre-seed and seed stages.
Yeah.
Great, so I think we're going to move on to our next question, I suppose. Can you raise a seed fund, a seed round remotely? You know, I'm from Ireland, which is, it's a smaller market. So, do I need to get on a plane? Do I need to go to London, or can I do it on Zoom, or should I go to San Francisco? How should I do that? So, Carmen, maybe you can take me through that one.
So, to the question, can I raise remotely? Yes, 100%, definitely, and everything. I think COVID changed the rules of the game there. At the beginning of COVID, we were all wondering whether we would get comfortable funding teams, just meeting them over Zoom. 100% happening. I've done it in the past few months. No need to take a plane. No need to be in disadvantage with local teams in London. Now, having said that, I would say if you can meet in person, like if they happen to be in your city, go meet in person if you're good at that, but it's not needed at all. And I think one thing I would add to that actually is it's not only that you do not need to live in London, you do not need to live in SF to raise a round. Also, you do not need to be a Delaware corp. You do not need to be necessarily a UK corporation for that. That has also completely changed. So US funds do not make you switch or flip anymore, only YC does, and that's like the only requirement. So on that, I think when you even take a step before and think about where do I incorporate my company, think about practicalities of where is it most efficient because of where you live, because of the costs, right? Delaware is 3 times as expensive as having a UK company because auditors and accountants and lawyers are 3 times more expensive. So think about it from a practical perspective, what's the best for your business and optimize for it as a business decision, because from a fundraising perspective, it doesn't matter. Like Spain, I'm from Spain, so I can say this, Spain is notoriously annoying to close a round in, Germany as well, but still you see US funds going through the whole hazard. It goes back to if the intrinsic value of what you're creating is exciting, people will go anywhere to fund you. So it's never the kind of deal breaker or deal maker. So just optimize for it as a business commercial decision.
And I suppose my next question is, in the past, there was a kind of a journey that some founders went on where they left Europe, they moved to San Francisco, they raised funding from people like Jason, and were very successful. Do you see that happening again post-COVID, or how do you see the new world? Are US funds investing from SF at seed into European companies, and how is that working out for founders? The question is to Rouven, I suppose.
Yeah, as Carmen just said, US VCs, they flocked already to Europe, and that can be via franchises for a long time, like Excel, for example. That can also be via, just newer subsidiaries. Sequoia, for example. And what is important to understand is that typically the US VCs here in Europe, they operate somewhat on their own, right? So if you raise from them, you raise from them. And if you want to raise from their parent or the big sister in the States, then it's a different ball game. So there are situations where, and this is happening often, where you would then have to convince, and your partner of the European franchise has to convince her partner in the States and the IC, investment committee, to basically back you further. And this process actually can take like 2 or 3 months. I mean, we talk existing relationships, and so be prepared. And in this regard, I think it's extremely important for European founders, especially the ones more on the technical side of things, to learn how things work in the States, because I think all the Americans here, they can subscribe to that, in terms of storytelling. The Americans are just 1 or 2 steps ahead of us Europeans, and I'm German, so the Germans are not that good in storytelling. And some other friends, we talked about that before as well today. So be prepared, and therefore, could be a very, very wise thing at one point. Maybe if you are like post-seed, Series A is coming up, you maybe really want to take a trip to the States, meet up some friends, you meet along the way, if not just go there solo. You know people by then who can introduce you, breathe the air, learn how things work, just hang. It doesn't have to be a year, go for a week, 2, 3, whatever you fancy. And ideally you can already find maybe even more customers, testing the waters over there, get some first testimonials. So you can do many, many, many things, not only learning when you go over to the States. And maybe one thing though on the closing, typically when you close a round, typically a VC would like to see you at one point, and you should also want to see the VC at one point, because you're entering sort of like a marriage, right? And yes, you can do it virtually. There are all kinds of nice dating sites out there, but ultimately, we are in a real world, and you kind of have to see if you get along. So and do reference calls on your VCs a lot, and also allow them to do 1 or 2 on you.
It's great. So we're going to keep moving. So the next topic we're going to kind of cover is how to structure my cap table. So Zoe is quite passionate about this. So maybe Zoe, I'm going to ask you, who should I have on my cap table? Should I, what's the dream team that I should be looking for? And how should I approach that question?
No, I'm joking. When he says passionate, I promise that I have other hobbies other than thinking about structuring a cap table. But in all seriousness, so if I was European Founders Day raising a seed round, I would absolutely want a European seed fund whose fund totally is used to investing in businesses at my stage, is used to all of the problems, the ups and downs that comes with it, has a very good conversion rate of raising the Series A and helping them raise a Series A, has invested in businesses in my sector, and has a very good relationship with some really dynamic angels. I would want to be meaningful to that fund and to those investors. I would want to represent at least 1 or maybe 2% of their fund as a primary investment out of the gate. And the reason I kind of say that to you folks is that, yes, it's fantastic that there are crossover funds, massive funds, global funds who are moving into Europe because they're so excited by what you're all building, and they should be, but you do not want to be a sub-decimal point in that fund, I don't think, at the outset. And that is because you are just an option. And when you become an option to a fund, and times get shit, which they do and they can, you want them to want to roll up their sleeves for you. You don't want them to be like, where's this financial data, which you're not used to preparing yet because it's not the right stage for you. And equally, you want your next round to be successful, and you don't want to have to think about the answer to the question, why is X fund not leading this round? And you don't want to then be not able to cause like a competitive tension in the round. So I would heed caution at bringing a non-typical seed investor into your cap table at the beginning. That being said, I have absolutely co-invested with kind of crossover funds, multi-stage funds, who have come in as a kind of supporting investor role, and that has worked fine. I would just add a cautionary hint, because I think that it's your business, you're building something that's very meaningful to you. It should mirror with the people who you surround yourselves with. And I think that when you matter so much to those people at the beginning, they will do a real solid by you.
And I suppose on to the next question, how do you reference, or how do you advise founders to reference their VCs? Carmen.
Yeah, I think that's a very important one, because as we were saying earlier, it's not even like a marriage. You're having kids with these people, because to get somebody out of your cap table is more difficult than to divorce somebody. And I'm saying I got married on Saturday, so I have thought a lot about it. But basically, it is super, super important, and ultimately it all comes down to personal fit and wanting to work with these people, right? And mattering to these people, and knowing that you can call Zoe or you can call me at like 1 a.m. for good or for bad news. Those are the ones that you want now they'll get like their sleeves up when like things go wrong, because they will go, and that they'll jump with you when like there's something to celebrate. So how do you know if these are the right kind of, how do you reference them? I always share with founders some criteria or framework. So we mentioned like skin in the game. How do you measure skin in the game though? Look at, one good way to do it is look at your ticket size as a percentage of the fund size, right? And the fund size is public information generally, so you can check whether you're at 0.01% of the fund or you're 10%. It's probably extremes, but that is one. Also look at relative ticket size, so ask them. Because if they always invest like 100K and they're investing 100K in you, it's perfect. But if they generally invest 10 million and they're investing like 100K in you, that is tricky, right? And it's tricky because when things go wrong, or the incentives for me to spend time with a company where I have 10% versus where I have 1% are different, right? And it's not that they're better or worse humans, it's just business and economics of the fund, right? So I think that in like very kind of quantifiable ways of how do you quantify skin in the game. Now, personal fit, that's why, as we were suggesting earlier, maybe go meet them, try to meet them, have beers, either over Zoom, things like that. And last but not least, make sure that you reference them, and that you reference them independently and with companies where things went wrong. Because with companies where things went right, it's always easier to have a rosy picture. So in my advice is, if you know people who know founders of this fund, ask for references. And if you don't, find them on LinkedIn and reach out. I think that's another way to do it. If you don't even know how to check what went right, what went wrong, there is a website called Crunchbase. You can download the companies that a fund has invested in, up to a limit if you don't pay, but the freemium version works. And you can check and be like, okay, so they invested at seed here, and this didn't raise an A, this looks like it went wrong. Like, reach out on LinkedIn and try to find out how helpful that fund was or how helpful that person was.
Interesting. And if you're a seed fund now, I think it's important as well to look at, does the fund have capital, where it is? So maybe, Zoe, you can kind of talk about that a little bit, because certain funds might be at the end of their row, have less capital available. And also, I think maybe, if you could talk about that, would be great.
Yeah, and again, this is us trying to, I guess, teach you to ask the right questions that will empower you to really understand how your investor is potentially looking at you. So funds that are typically closed funds might be around and deploying and investing capital for maybe like, times have changed, but let's say 3 to 4 years. So they'll be making investments over that period. They will then spend the rest of the time perhaps deploying something called reserves, so money that they've held back, which they want to carry on investing in some of their companies, not all of them. And then they will have a period where their own investors will be expecting them to return that capital back to them. And that can often be, from year kind of like 8 onwards, but it can be earlier. And so the reason it's really important for you to know whether you are kind of year 1, new company out of the gates for this fund, or a year 8 company, is so that you can understand what types of pressures your own investors may be under from their investors, because this is all a lovely top-down chain, ultimately. And the point I'm making here is it's really good to ask the question, so how big a fund have you raised, so you can understand the ticket size relativity point. What year are you into deploying that fund? How much of that fund do you typically hold back for reserves, just as well, so from the outset you know whether you can expect more capital from them or not. And then perhaps it's a good idea to ask a couple of other questions. One, about competition or potentially adjacent companies that could be perceived as competitors. If you should be able to do this, but the reality is you'll be looking at a lot of funds to talk to, and to do this amount of homework can get quite a lot for you guys. So it'd be good to understand their view on competition and investing in direct or indirect competitors, so you know whether, again, you are an option or their choice. And I think the other point to ask is kind of how many exits or like winners that they've already had from the fund that they're in. And I say this because, again, this goes back to the pressure point. If you know that your investor is in year 7, 8 of their fund and they're talking to their own investors every 6 months, you can bet your bottom dollar that those investors are saying to them, where's the next return coming from? And you don't want to be that founder who is forced to find a buyer for their shares in the next few years, which distracts you, which takes your mind off building the business, just because you didn't at the outset kind of come equipped with some of these questions. And I know that's probably a lot to take in, but I think it's just really important to try and understand as much as you can all the different incentives at play with the people who are ultimately going to be taking a chunk of your business, just so that you can start understanding how they could onward relay that pressure to you whilst you're building an absolute rocket ship.
Interesting. And Rouven, I just want to ask you a question about, we're all institutional investors, but there are, angels that are slightly different. Why would you take institutional capital versus angels, versus friends, versus, maybe talk about the advantages of what you're offering? I mean, will you, if my company is going okay, I'm not going to raise an A, but I need more capital, will you come and give me money?
Yeah, I think it's a very good question. And, also alluding to Carmen, to what you said. Basically, when things go sour, I mean, a VC could squeeze you. I mean, that's really the extreme of the VC you don't want to have, yeah? To squeeze you for whatever funds she can get out of it. I mean, it being your company. And 2 is just get himself a put option to give back the shares for €1. Yeah, so you can deal with your own liquidation of the company, which I deem as the neutral option. Yeah, neither supportive nor harming you. You can do whatever you want. Yeah. But then comes really the supportive option, and that's something like we do at Cavalry, for example. We always try, because we are entrepreneurs ourselves, so having built quite a number of companies over the last 10 years, and to move things around, because often you can move things around. I mean, there are levers you can shrink until you grow again if you're in such a situation, or we keep up the equity story. So often you don't want to get a down round, because that kind of is a bad signaling in the market. So what we like to do is keep the momentum, basically, keep your valuation, put in more money, make a plan, support full-time with operations such as, we have HR, we can support with HR, finance, legals also in-house, cost you nothing, communications, PR, even crisis PR, we can support if necessary to make something ugly look beautiful again. And why do we do it? It's not, it's also because of we believe in the company first and foremost, but it's really more about supporting the founders and being thankful that they chose us as a partner in the first step, that we were allowed to invest. And then, as you said, that once we parted ways, maybe at one point, even if the company may fail, that they speak good about us, that they would recommend us. And we get actually tons of recommendations from founders where things didn't work out ultimately with their business. And that's how we look at it. So it's a long-term game. So we don't want to earn on that single transaction. Then we would, but I think that also funds are different. So if you do your reference checks, you understand who is really in for the long run and who is like opportunistic. Yeah.
And one question, we talked a little bit about it earlier, Zoe, was competitive companies. I mean, I have a great seed company, my seed investor invests in a competitor. How do you reference that? How do you look at that? What are good questions to ask VCs about how they might approach that, potentially?
If they say that they have got a competitor.
Yeah, or how they are maybe asking them, we talked about asking them what they viewed as competitive companies and how, how do you think about that?
Yeah, I mean, again, for me, I'm hoping that either you've gone to a really specialised fund or you've gone to almost like a spray and pray hundreds of people fund, just so you understand that those are probably the two most common where I would find quite competitive companies to be the most likely. So I would be asking them just straight up, do you have anyone who you think either now or in the next 2 or 3 years could start overlapping? And for me, the overlapping point is kind of where it's probably going to be where you're competing for budget. So are we selling to like the same type of buyer, the same persona, and are we essentially therefore, whichever our go-to-market motion is, but wanting the attention of the same person? So when I come to you to talk about customer BD, are you also going to be talking to this business about this? And then I would sort of be saying, do you often merge companies? So there is a worry that if you are the more successful one and there is a less successful one in a sort of a very adjacent space, that one of your investors may put pressure on you to acquire the other one, so which you might not want to do. So I'd ask about their attitude to merging companies, because it's a way of keeping them alive when some should perhaps die. And then finally, I would just be as direct as you can be, because you are building hopefully an open and transparent relationship with this investor. So I would just say to them, if there is going to be a choice in your reserves, will it just be on performance? Like, is there going to be one winner out of this? And then it's on you as to whether you are happy with kind of the answer to those questions. But I think no investor gets worried about being asked those questions. They should be happy to give you their candid views on how they see that play out.
Awesome. So yeah, we'll keep moving. So the next topic, I suppose, is how to create momentum when you're fundraising. I suppose we hear a lot about that in the market. It's a bit of an art. But I was going to ask Carmen first of all, because Carmen has interesting approach to this. So Carmen, how do I hack the fundraising to create momentum?
Sure, I love this question. So I basically brief intro so you get a bit of context, but I founded Cocoa. We were VCs for many years, then now invest like angels. So we try to exactly become the in-house VC for founders and help them, amongst other things, like hack their first round of funding. I think that I was saying earlier, like, whenever you decide to raise, but when you're raising, right? So like, how do you think about it? Think about it as a B2B sales funnel. It is literally that you qualify leads, i.e. funds, and you focus on getting them down the funnel or out of the funnel up until you get a or many term sheets. And then there's another phase in which you choose, but that's how you need to do it. Now, there are many different ways to create that momentum, and ideally, and best case scenario, you have an ally, an insider, be the founder that like has raised and has the network, or an angel that supports you and has the network, or a VC that is like smaller and has the network, so that they can help you create that momentum and that word that we don't like but is always around, which is the FOMO, right? The fear of missing out. Now, there's so many other factors that come into that I wouldn't stress too much about that FOMO. I think that there is much more about the intrinsic value that you create, about choosing the right market moment. and then just running the process and being execution machines. Like, it is very important to realize that when you're raising, that is what you're doing. And I understand that as a founder, it feels like the opportunity cost of the time away from your business is very high, and it should feel high so that you minimize it. But at the same time, you raise money to build a business. So what you're doing when you raise is also building the business, right? And what cannot happen, I had this situation where I was helping a founder for many months as he was thinking whether to raise or not. And then he was like, I'm gonna raise now. I was like, okay, great, I'm gonna make an intro. I made an intro to like a top VC, and the investor walks out of the meeting and goes like, oh, I love the guy, but he's not raising. And then I went to the founder, I was like, he thinks you're not raising. He's like, oh yeah, I wasn't super clear. I was like, do you want to raise? And he's like, yes. I was like, then you're raising. You cannot let anybody get out of a call without knowing what the next steps are so that you keep moving them down the funnel. Now, depending on how this works, you can do it more subtly, less subtle. Like, there are many arts here. This is like dating, by the way. It's exactly like dating. So if you're good at dating, you'll be good at fundraising. But the point is, however you communicate it, but you need to be ruthlessly focused in raising. That's like the best kind of way to create momentum and to run your round, I think.
And how much time should I be thinking? I want to raise my seed round. How much time do I need to give? And then initially, how do I figure out who's an insider? How do I get in touch with an insider?
Yeah, that's tricky. I agree. So on the timing, it's very good question, and it's important for your own expectations management. So I think it can go anywhere from first meeting to term sheet, and jump in with me for a seed round. But I would say it can go anywhere from like less than, even in the craziest times, like less than 2 to 3 weeks is very rare. And to the point, again, you need to get to know these people. So I advise you take the time to like connect and reference them and benchmark them. Up to like 2 months, like or so, we've seen. Now, what is interesting about this question though is you need to realize, and this is very important for expectations management, that the round doesn't end when you sign a term sheet. That even, except if you do a SAFE, and even if you do a SAFE or a shorter like convertible, then there are the legals. So there is a second step that is from term sheet to money in the bank. That will take less time of you, but that you should still be on like crazy execution mode, because up until the money is in the bank, this thing is not closed. And that part tends to be, if you do like long forms, which we call like actual legal documents, like a priced equity round, that takes from 4 to 6 weeks. And it is important for you guys to know, because generally founders struggle a lot with that, because they think term sheet done, I'm done. And then you have all this like long tail of like lots of things. So I think keep that in mind as well. And then how do you meet insiders?
Yeah, I think that's maybe Rouven or Zoe. I mean, how I'm sitting in my home office. I'm in wherever, in Waterford, where I'm from. How do I, I'm not from. I'm a great coder. I've got a great product. I've got some traction. How do I go about meeting insiders? Because it seems to me venture sometimes is a game of insiders versus a game of outsiders. And maybe the outsiders are the ones that should be getting more traction. Like I'm sitting in my room. How do I become an insider?
Yeah.
So I guess many things to say about this. So you may have no insiders, and that is also fine. And I say it's fine. The truth is, it could well be harder. But it's sales. You are learning the art of a cold email, a LinkedIn approach, which is compelling and interesting and short and to the point and shows you have researched and have a reason to be communicating with this person. So there is that approach. You can be your own best champion. But the other thing to remember is, from ideation to before you are fully officially fundraising, you should be, whether it's in your home market or other markets, doing exactly what you're doing today, networking, meeting people, whether that's other founders, whether that's early angel investors, accelerators. You should be testing your idea out on various groups of stakeholders as much as you can, because you'll be convincing various people, including your early employees, that this is a great idea. And there will be one person, there has to be, for you to think that this is a great idea. He'll be like, this is a great idea, and it's such a great idea that I'm either going to give you my time, which is super valuable, or my actual money, which is literally valuable. And one of those people will, again, it's a kind of compounding effect, but they can be your biggest champion the whole way through. And it's why you must never kill your earliest investors, and you must remember this later on, because they will have been the people who've taken the earliest leaps of faith. So I would say it's a great advantage to have, but don't think that you have nothing if you just have cold approaches, and that you will inevitably be building a network the whole time from start to...
Yeah, maybe in this context, you can find on Crunchbase that Carmen mentioned, you can find what kind of angels have done which deals. So if you don't know them via your network, so find a way to get to those angels, because when you have a great angel, a person who funded or founded, ideally both, before successful companies, ideally unicorns, but can also be soonicorns. Try to get this person on board, and typically, those sort of angels, they invest in teams. And oftentimes it's way better to do a concentrated approach to get 1-2 of those superstars on board, as opposed to doing spray and pray, don't invest enough time, never even send out just generic, messages on any medium to any investor you want to work with. And because ultimately, as a role of an angel and also as an early stage investor, your incentives are aligned between you as a founder and them. So once they are on board, they support you if they're good investors with what you need.
And if I may add something very quickly. So the reality is, when we talk, when Zoe was saying, you don't need an insider, you don't. It will be harder, but the reality, and this is not because we're all snobs that only like to hang out with each other, is because we get hundreds of companies as inbound, and we read through all of them because we have full respect for the time and the energy that everybody's putting behind that. But the reality is that when you look for signals, if somebody you really trust, if Zoe sends me a company, I'm for sure gonna meet that company, because to me it's already a great sign that she wants to send that to me, right? Now, if I read a cold email, I'm gonna read the deck, but I don't have that extra signal, so I might still fall in love with the company and ping you back and have a call, but it is one signal less. Now, having said that, also, nobody is born an insider. You become an insider. We've all backed companies. There is a company I actually angel invested with, one of Zoe's partner, that got through me because Zoe's partner knew a guy from Burning Man who knew the company. And so this company, these founders who were 22, by the way, spoke to everybody on earth. And this guy who went to Burning Man with Finn told them, oh, I know one dude from BC. And so they introduced him to Finn, and then Finn introduced them to me. And then that's it. You know what I mean? It's meet everybody, talk to everybody, hustle your way through, and there will be one person that will see the value that you're creating and will champion you. So it's not, nobody's born an insider. So if you're in your office in Dublin by yourself, don't think that you don't stand a chance, because, even Johnny from Hopin, by the way, he had been rejected by everybody, got through me via an angel that he harassed for months. So that's the point, right? We can all become insiders if you hustle your way through it.
Agreed. So we're going to keep moving. So on to the kind of last topic. I suppose it's what's the seed market like now in Europe? Is it a good time to raise, which we kind of covered earlier? But are you guys investing? Are you in the market? What's changed? Maybe talk me through, Zoe. What's happening?
We're absolutely investing. We aren't the only ones. It's a great time, as everyone will tell you, and I could recount all of the things about every downturn in the market. It is a great time to build. However, warnings are, talent is still expensive, and some founders' mentality and psychology hasn't yet shifted into the fact that we are slightly entering a new price-disciplined, have you got 24 months runway, will a growth investor love what you're building world, which just means actually that for you to be successful now, you have to be amazing. But isn't that great? And Europe is a wonderful place to be. There's a lot of capital and there's a lot of conviction. So for me, positive, but with the couple of warning signs.
Yeah, and Carmen, maybe you can kind of talk us through, you had some views around, valuations have changed and expectations around valuations might have changed.
Look, I think the best companies are actually created in like situations like this because it cleans everything else that like should not have got funded, that like should have that. It just gets clean, and that makes more talent available, and also like it sort of spikes creativity. So we're incredibly excited about the companies that we will see being built in the next two years, right? At the end of the day, you need to think about like the intrinsic value of what you're creating, of the technology that you're creating, is moving upwards. What you need to make sure is that from now till the market sort of recovers again at later stages, you do not need money, so that you're not caught in the middle of the dump. That's a little bit how we think it. Now, that has also to do with the valuations at which you reach seed, because what was happening a year ago was that we were seeing like seed rounds of 5 at 30, which by the way were Series A's when I joined VC. Like when I joined VC 7 years ago, that was a Series A, but that became a pre-seed a year ago. So like 5 at 30, great. That means your A needs to be at like 120, 150 million. Now, they were happening. Now, today, to raise around a Series A at 125, people are going to ask you for a lot of data, for a lot of traction, like the bar is very high. So you're not serving yourself well in raising a seed at 30, because you're putting a lot of pressure on yourself and the performance that you need in order to raise the next round. So how I would think about it now, I don't think rounds are going to get much smaller, because investors still want companies to have enough funding to go from one side of the market to the other. But think about how much money does my business need for the next 24 months, plus a buffer, as we were saying. And then think about dilutions or percentages or the price that you pay that make more or less sense, so that if you then take the valuation that you end up, you multiply by 3, 4, which is your next round, and you feel like I can build a business that can be valued at this in 24 months, right? And do not think, when you look at the terms, do not think about the valuation top line. Is it like 20? Is it 30? Is it 10? What matters is the price you're paying, and that is the dilution. So actually think about the size of the round, which is what should be the driver because it's the money the business needs, and how much you're paying for that, the dilution. The valuation itself is just a product of those two, but it's highly confusing because you can be raising at 50, by the way, 50 million, and it can sound very high, but you might get being diluted 50%, right? And that is like, makes no sense. You might raise at 10 million and being diluted 10%. So like, think about like the actual size of the round and dilution or price that you're paying rather than a top line valuation, because it's very confusing.
I may have two final things.
Yeah, we're wrapping up shortly.
We are running out of time, and I think you have the final words, David. One is like, we had a SaaS conference, and the underlying trend of continued digitization of the established companies, it won't go away. We are in full force, and there's amazing companies. Most of them actually, they have 60, 70, 80% equity quota. They can endure a crisis. They have the right management teams, CDOs, etc. They know how to purchase SaaS products. So they will continue. So just follow the trend. Maybe look who are the good clients of yours. There are some who may go out of business, who don't have that much of a good equity quota, who don't have a good management team, who don't know. So really be careful whom you actually yourself spend your valuable time on onboarding as a client. And then the second thing is, next to the client selection related to, actually I forgot the train of thought, to be frank.
Yeah, so I think that's the end of today. So yeah, thank you everyone for joining the conversation. I want to thank Jason. It's been a great event, so appreciate it. Appreciate being here, and hopefully everyone has a great time. Thank you, guys.
Thank you. Bye.
sorriu, venceu, depois chorou. Então fui eu quem consolou sua tristeza, a certeza de que o amor tem desas fases mais. E é bom